Yeah. Okay, good morning everybody. Yeah? Okay. I think it's about time to start. And now the mic is on as well. Excellent. So good morning everybody and welcome to this conference on debt and innovative finance in developing countries, jointly organized by Bank of Finland Institute for Emerging Economies and UNU-WIDER. Without further ado, I would like to welcome Pasi Hellman, Under Secretary of State from the Ministry for Foreign Affairs, to open this conference. Thank you very much. Pasi, welcome.
Good morning, ladies and gentlemen. It's a pleasure to be here today. And the topics of this seminar, debt and innovative finance, are of great importance for the Finnish international development policy and work. And to my understanding, this is the first ever UNU-WIDER Bank of Finland Transition Economies Center joint conference, and that is a very welcome development. Congratulations. The pandemic, the climate change, food and energy crisis are having a devastating impact on financing of the 2030 agenda and the sustainable development goals. According to recent estimates, 4.2 trillion US dollars are needed per year, and this is more than 20 times the annual amount of official development assistance. It is clear that ODA alone is not enough, not even if it will need to play a strong and hopefully a catalytic role in development financing. Then how to enhance trade, investment, remittances and other private flows between the developed and the developing world for sustainable development. One answer by the European Union is its massive Global Gateway initiative, aiming to channel 300 billion euros for infrastructure, digital, energy, transport sectors and the like, connectivity projects around the world. Money will come from both public and private sources, and half of it is earmarked to go to Africa. But also how to curb illicit financial flows from developing countries, how to strengthen trade and investments between the developing countries themselves in Africa, for example. We think that support for enabling business environment, rule of law, predictability, removing barriers for trade are needed, and development finance can help in all that. And of course, least developed countries and fragile states are in particular need. Assistance there is very much needed. In Finland, alongside our traditional grant-based development aid, we have innovated in designing a new instrument to use what we call so-called development policy investments. We work with multilateral and other partners to leverage public and private funds for the benefit of development and climate. So far, our investment portfolio is over 800 million euros, and it's expected to increase to over 1 billion in the next couple of years. In developing countries, a strong domestic resource and revenue mobilization is also needed, and I am aware and I wish to commend WIDER for its very good work on that issue. For our part, we have established a tax and development action program involving in developing countries, in our partner countries, national authorities and civil society organizations to strengthen tax compliance. Innovation then is very much needed in climate change and green finance. Adaptation to climate change is a pressing issue, particularly for developing countries. And it is good that on the road towards the COP27 in Egypt next week, more attention has been given to it. Financing for adaptation activities poses a challenge as private funds are clearly more targeting climate change mitigation. So we need new approaches. And while we need to be innovative with financing, we also need to recognize the debt issues and the serious challenges they pose for developing countries. The pandemic really hit the debt sustainability of developing countries so that many now have great difficulties to honor their debt service obligations when trying, understandably, also to ensure sufficient expenditure on basic services for their citizens. And China's rise is, as the biggest global international lender, makes the debt challenge different from the previous time debt issues required strong international collaboration in the form of HIPC initiative. And China not being member in OECD nor in the Paris Club of creditors, questions have been made about the motives and transparency or non-transparency of its loan agreements, issues with excessive loans or too big of a reliance on one creditor country. And quite frankly, through its somewhat slack approach in loan provision for many years, China has caused a debt problem also for itself. For now, it is true and welcome that China has accepted some debt restructuring arrangements. Actually, since 2008, Chinese creditors have arranged at least 71 distressed debt restructurings. This is interesting compared to the total number of Paris Club restructurings, 68 cases. And China's participation in the G20 debt relief process, particularly in Zambia this year, is a welcome development. However, more needs to be done, particularly a comprehensive and effective creditor coordination and debt relief and restructuring system should be ensured and strengthened. So, ladies and gentlemen, I wish you all a fruitful seminar, and as a former UNU-WIDER advisory board member, it is a particular pleasure for me to wish you all that. Thank you for your attention.
Thank you very much, Pasi, for those kind words and on sort of quick wrap up on some of the topics that we will be discussing during the next 2 days. So my name is Iikka Korhonen. I'm the head of research at BOFIT, the Bank of Finland Institute for Emerging Economies, and one of the co-organizers of the conference. On my behalf and on behalf of my colleagues, of course, I'd like to welcome you all warmly to Bank of Finland, and I would like to thank Kunal Sen and his colleagues at UNU-WIDER for great cooperation during the preparation for the conference, and I'm really looking forward to the discussions during this day and the next day. And of course, warm welcome also those who are following the conference via the internet stream at the moment. Before giving the floor to Kunal, just some words about the practical details here. So people in the audience here at the Bank of Finland are, of course, really free to pose questions, comments during the Q&A sessions. We hope that there's lively discussion on social media as well. If you, for example, are following the stream, you can use hashtag DebtConf2022. This will be sort of displayed later as well, and hopefully the questions can be picked up by moderators or then the answers at the later stage. The conference or the video stream will of course be available later, I think both in the YouTube channels of Bank of Finland and UNU-WIDER, hopefully at least at the latest on Monday. Then I will give the floor to Kunal, please.
So good morning, everyone. I'm Kunal Sen, the director of UNU-WIDER. I'm very pleased to welcome you to the BOFIT WIDER Conference on Debt, Innovative Finance in Developing Countries. UNU-WIDER is a research institute, UN agency, think tank, all rolled into one, in existence for over 36 years. Really, from the very beginning of UNU-WIDER, we've been working on macroeconomic challenges that developing countries face, and we have very highly regarded publications in that area. It's the first time that we're organizing a conference at BOFIT, and thanks so much, Iikka and his colleagues here, on a theme that is very important to both our institutions, and this is exactly why we decided to do this conference together. We're grateful for this partnership and the opportunity to hold the conference at the beautiful premises of the Bank of Finland, and for those of you who've been here the first time, you'll see how beautiful the premises are, both here and also when we go for dinner later on. When we planned this conference a year back, it was about a year when we started planning this conference, little did we know that the problems that European countries are facing on debt will be so very relevant today. I mean, we probably had very little idea that a year later, we're in a very totally different place on debt. The developing countries are in the midst of a debt crisis that is not seen since the 1980s. 40 years ago, when we thought about the debt problem at that time, most of the debt was owed to governments in the West, official bilateral creditors, nearly all of whom were members of the Paris Club. Now, what we have is a situation, it's absolutely different. At the end of 2020, low and middle income countries owed five times as much to commercial creditors as they did to bilateral creditors. This year, of the nearly $53 billion that low income countries need to make on debt service payments and on their public and public guaranteed debt, just $5 billion will go to Paris Club creditors. That's quite remarkable, really. So several of the sessions in this conference address the challenge of the debt challenge that developing countries face, especially the landscape that has changed dramatically in this last 40 years, where we have commercial creditors and China also being very important lenders. But also there are opportunities with fiscal policy and financial instruments that we also need to recognize. This year marks the 30th anniversary of the adoption of the United Nations Framework Convention on Climate Change. And we are away from COP26, just 10 days away, and there's a critical need for developing countries to access climate financing. And how does that happen at the level that we need? We also have increasing recognition that innovations such as green bonds allow significant opportunities for developing countries to finance zero carbon pathways. Instruments of this kind were not available before. We'll begin with the first keynote today to be provided by Professor Hugo Panizza, and the keynote will be chaired by Professor Tony Addison from the University of Copenhagen, who is and also a non-resident senior research fellow at the UNU-WIDER. The second keynote will be delivered by the Nobel laureate Bengt Holmström virtually later today, and the third keynote by Sarah Gollenbreder tomorrow. The plenary sessions on green finance, corporate debt, and sovereign debt, we try to make sure in this conference that we covered all the bases. That was why it was very important to have sessions on corporate debt, which is often left out in conference on debt. And it was very important to have a session, which is going to be a fantastic session on corporate debt with very leading scholars and who will speak on that, and also sovereign debt and on green finance. Also, so exciting was that we could get the two major reports on financing sustainable development this year, one by the World Bank, the World Development Report 2022, the other by the United Nations, UNDESA, on financing sustainable development in this conference. So I was really, really pleased that we could get both these reports be presented in this conference. Now, over to Tony to be the chair of the first keynote. Thanks.
So thank you very much, Kunal. If I could invite Hugo to come to the podium and to welcome you all again to this meeting. I'm Tony Addison, professor at Copenhagen University and a non-resident senior fellow at UNU-WIDER. And it is my great pleasure to welcome Hugo Panizza, who is professor of economics and the Pictet chair in finance and development at the Graduate Institute of International and Development Studies in Geneva. Hugo is also director of the International Center for Monetary and Banking Studies, a vice president of CEPR, a fellow of an Italian foundation, editor of Oxford Open Economies and International Development Policy. Hugo is formerly chief of the Development and Finance, Debt and Finance Analysis Unit of UNCTAD and a senior economist in the research department of the Inter-American Development Bank. So I think Ugo is going to get us off to a very nice start here today in the first keynote of this meeting. So welcome to Helsinki again, Ugo. Thank you.
Thank you very much, Tony. Thank you for the invitation. It's a great pleasure to be here. It's actually the first time I'm in Helsinki. It's not the first time I'm in Helsinki. I've been in Vantaa airport many times, but I never left the airport. So that's the first time I'm actually outside the airport. So I'll be talking about this climate and debt. And this it's based on a report that we just published. This is the Geneva report on the world economy, which is produced by the International Center for Monetary and Banking Studies. This is usually commissioned to external experts, but this time I was one of the authors. And the other authors are there. So it's Patrick Bolton, Lee Buchheit, Mitu Gulati, Beatrice Veder Di Mauro, and Jerome Zettelmeier. So a few economists and a few lawyers. And so I click on this. So I was not at the annual meeting 2 weeks ago, but my friends who were there told me that there were two big topics. One was inflation, and the other one, which will be the topic of the Geneva report of next year. And the other one was climate and debt. And so there is this idea that there is, it was mentioned before by Kunal, there is this issue that we have these two crises, one which is related to excessive debt levels everywhere, not just in emerging and developing countries. I'm Italian, so that's something I think a lot about. And then, of course, the climate crisis, which is an existential crisis for the planet. And I'm going to present, organize my presentation around these four numbers. So hopefully as 300, 400, 60%, and 6. So this is the outline. I will say, and this is the way the report is organized. So a little bit about the climate perspective. A little bit about debt and fiscal space. Then the discussion of financing, which was mentioned before, which is key. And then I'll briefly discuss what we see as policies. And I didn't put the slide here. I talked about this report in Cornell a few weeks ago, and I had these slides with the perspective. So I had some, the perspective of the people in finance, the perspective of the people in the NGOs, and the perspective of the economists. And the economist, the typical card-carrying economist tells it's simple, just carbon tax. And, and the typical NGO guy will tell you, well, just, cancel the debt. And the typical finance guy will tell you, oh, we'll have all these amazing instruments, the private sector will solve it, right? And our perspective is that, all these things need to be part of the solution, but there is no really silver bullet. So all of them play different and important roles, and I'll try to say something about that. So let me start with the climate perspective. And here you wanna, there are maybe four issues that you wanna talk about, and one is the view from the planet. And then there is a local perspective. And then you want to think about conservation. Conservation really has some overlap with climate change. It's more a consequence of climate change, but it's an important consequence. And then we want to think about equity. And so, I was trained as an international finance person, and, you always taught me just like this, the Mundell Mendelian trilemma, right? That you cannot have a floating exchange rate, a fixed exchange rate, independent monetary policy, and free capital mobility. And then when we think about this, we almost feel that there is this, maybe it's not impossible, but a difficult trilemma, right? You would like something which is feasible and scalable. You would like something which is fair, and you would something that is politically acceptable, and it's not easy. So I said that I gave you 3 numbers, so let me go to the first one. So these are the estimated from the International Panel on Climate Change. And so they have a distribution, so we don't know the future for sure, but the scientists are telling us that if we want to limit the increase in global temperature to 1.5 degrees, we had 2 years ago, so we have less now, 300 gigatons of carbon left. So that's the first important number. That was the budget 2 years ago. In the meantime, we put other 40 gigatons in the atmosphere, so now we have 220. Let me put this. So that's the first number. The second number is how much we're emitting right now, and it's about 40 a year. So if you do 300 by 4 divided by 40, you get about 8. So at current emission level, the target will be breached in less than 8 years. And that's something that I didn't realize before starting working this. That's kind of scary. Now, what it matters for climate change is how much CO2 there is in the atmosphere. It doesn't really matter who put it. But we as people care about it. And if you look, so this is a map in which the size of the country is scaled proportionally to how much CO2 these countries are putting in the atmosphere. And you see that Europe is very large, and you see that Africa is almost not there. You can see South Africa, but you cannot see anything else. The US is more or less to scale because the US is a sparsely populated country, so it put a lot of CO2, but it's also, very large geographically, so you don't see. But the case of Europe, it's and the case of China also, it's Japan, and you can barely see Africa, you can barely see Latin America. So that's who's putting the stuff in the atmosphere, and I will show you a similar map soon, which makes a different point. Now, the point is that why are these countries not putting much CO2 in the atmosphere is because they're poor, right? And that's clearly is not that's not an ideal equilibrium, right? We want these countries to become rich, but they cannot become rich like China became rich by becoming the largest emitter of CO2. So they have to become rich in a different way. So China has been a massive economic miracle, lifted millions of people out of poverty, and that's great, but it did it with all technology. And that we cannot think of sub-Saharan Africa of becoming rich in the same way because it would be an environmental disaster. So that's the global perspective, how much CO2 is in the atmosphere, and we don't care who puts it. You'll tell me when I have 10 minutes, Tony. Yes.
In very good time, Iikka, don't worry.
Yeah. There is also a local perspective that who is affected by climate change. And so in order to reduce the CO2 that we have in the atmosphere, reduce the flow of CO2 that goes into the atmosphere, we have to spend money into mitigation, issuing less CO2. But, climate change is happening, and, the 1.5 degrees threshold will be breached with we're almost sure, we're not going to go to zero emission in 8 years. That's pretty sure. And countries are being impacted by this. And here another type of expenditure is required, is expenditure in adaptation. How we adapt to climate change. We have to do it. And this will require investment in, dams and all sorts of stuff that protect countries from climate change. This is the darker this map, the more at risk from climate change you are. But let me show you a map that similar to the one before. So I scale the countries by size according to how susceptible are they at risk of climate change. You remember before we didn't see Africa, now we see it. Before Europe was huge, now we don't see Europe. We don't see the US. Look, I don't know if this point, look at the Caribbean. They're massive, right? So there is, in a sense, a very unequal distribution between those who are causing the problem and those who are suffering from the problem. And that's important when we think about some sort of fairness. This is just, let me skip up this. So there is this local perspective. These countries will need to spend money in adaptation, and the issue is, where is this money coming from? There is also the issue of biodiversity. And again, you see that countries which provide biodiversity services and where the biodiversity is more at risk, again, tend to be countries in the global south. And these are also countries which have a massive amount of unused carbon. You know, there are forests and which absorb carbon, but they could be converted in carbon if you cut the trees. They have mineral, they have oil, they have all this sort of stuff. And when you talk with these guys, it's a bit unfair that, you know, you guys became rich by pumping a lot of carbon in the atmosphere, and now you're telling us remain poor to protect the climate. So how do we conserve these assets? How do we create the right incentive? So let me just go into a quick thought experiment, and then we go back to that. So we saw that we have a budget left of 300 gigatons, actually less. And let's suppose, so again, let's put the hat of an economist and think how do we allocate this budget? Well, how do we reach this budget? Well, one way to do it is to allocate these 300 gigatons in some way, and then let people trade. So that's cap and trade. You know, we know that that's efficient because then the carbon. But the big question, how do we allocate these 300 gigatons? And that's where fairness considerations are important. Sort of implicit in the Paris Agreement that this carbon budget is sort of allocated to those who are polluting right now, which doesn't seem fair, right? Maybe another way to do it is that, you know, we allocate per capita. So we have, you know, 300 gigatons left. We have, 6 billions in the planet. We divide the 300 gigatons by 6 billion, and we say that, you know, each Italian, each Indian, each Finn has a right to put some gigaton in the atmosphere. And then maybe cutting emission, it's easier somewhere and it's more difficult somewhere else, and then we trade. But we start with this initial allocation. So, you know, when we study economics, we know that when under certain conditions, the market will reach an efficient thing. Of course, it depends, the fairness of this thing will depends on the initial allocation. And so maybe a fair initial allocation is that, you know, each person in the planet is counted equally, and each person in the planet get a given amount of gigaton and then can buy or sell. Now, this seems fair, but then some people say, hold on. You Italians or Brits or Germans or Americans, you already put a lot of stuff in the atmosphere. You know, we from, Congo didn't put much. And in fact, if you look at who contributed, so the blue are basically the advanced economies, and the red are the emerging economies. You see that the advanced economies, which less than 50% of the global population, they put much more than 50% of the carbon that's in the atmosphere. And if you remove China, which is this one, the rest of the emerging world really put a very small share. So there is this issue. There is, and we see it clearly. So if you do a regression where you put income per capita, how much CO2 you put in the atmosphere, these are clearly linked. One interesting thing that you can be rich and live well and emit less. So here, if you pick two countries, so the countries where I live now, Switzerland, and the country where I lived before living in Switzerland. So these are two countries with comparable standard of living. People in Switzerland live pretty well, and they emit about, less than half that what. So, at the end, we'll have to do something, but, something can be done without killing our standard of living. So something quickly about debt. Well, this is was implicitly said, debt is, so we'll need to spend money for both mitigation and adoption. And the ability to spend money is constrained by very high level of debt. There is a paper by, so here, when you do estimate, you see, 500 billion, 1 trillion, 3 trillion, it's sort of like who says the bigger number. But whichever number you pick, it's big. It's big, but then when you think this number, which is estimated by this bunch of economists at the fund that says 500 billion per year, it's a massive number, but it's less than 0.5 percentage point of the advanced economy's GDP, so it's not a huge number. So this is what it says before. So this is the third number I gave you, the 60%. And this was last year. So 60% of low-income countries are either in that distress, so that's the black bar, or are deemed by the fund and the World Bank as being at high risk of that distress. And so this is a way to see this, this fact that is constraining the ability of these countries, which are the ones who need to spend more in mitigation, to actually spend in mitigation. Let me skip this stuff. So this is basically shows you that even in emerging countries, there is precarious market access. Spreads are very volatile. They respond to shocks a lot. So another thing that we show in the report, that poorer countries are much more fiscally sensitive to climate shock. So a given climate shock in the US has a smaller effect on the fiscal deficit than a fiscal shock in a poorer countries. This is partly due to the fact that governments are smaller in emerging countries. Spreads, borrowing costs are more susceptible to external shocks, and they are more and more susceptible to climate risk. So this is Uli Volz and his co-authors have a lot of papers showing this, and we sort of corroborate their results here. And this push up borrowing cost. So the bottom line, that many emerging and developing economies might not be able to finance the need for adaptation investment. So Lenin would say, what is to be done? So what's the financing? And here we explore three possible solutions, three possible ways to address this, which were mentioned before. The first is the role of green bonds. And specifically, since we're talking about, one difference between mitigation and adaptation is that a lot of mitigation can be done by the private sector. So basically, I put environmental standards, so I do regulation, and then the private sector has to invest, right? And that's but adaptation is mostly provision of public goods. So I have to build a dam to protect me. So the private sector is not going to do this. Well, it's going to do it if the public sector gives it the money to do it. And so that's where you need fiscal resources. So when we think about green bonds, we're not thinking about the green bonds issued by corporations. We're thinking about green bonds issued by sovereigns, which it's a more recent phenomenon. But there is some puzzles associated with this green bond. The first one is that, and this is the great thing when you team up with lawyers, so lawyers go and read contracts. And I'll show you an example of contracts, which will make you a bit more skeptical about green sovereign bonds. Because there is really no commitment in that. So why do we have these green bonds? And green sovereign bonds, I'm talking. And the other thing that is discussed a lot in the literature, which again is sort of the other side of the coin, why do countries issue green bonds? Presumably because that reduced their borrowing cost, but the evidence of this so-called greenium, which is the difference between the yield of a conventional bond, of a green bond and a comparable conventional bond. But this greenium, it's either very small or it's not there. So this is a little bit the market for sovereign or quasi-sovereign green bonds. So here you have three colors. So the green one are sovereign-backed green bonds. So these are bonds issued by organizations like the German development bank KfW, which is not the German federal government, but which is fully backed by the German federal government. The blue ones are sovereign themselves, so this will be a green bond issued by the German federal government. And the orange one are local governments. So two things that I would like you to notice, that this is sovereign or quasi-sovereign green bonds are a European thing. So if you look at the scale, this is 80, and this is the US, this is 4. In the US, there is basically nothing issued by government or government-backed. It's all local government, while in Europe, the real sovereign, are issuing more and more. And there is, so this is 80, this is 4, and then the other big players are international organizations. So here the European Investment Bank has been a leader in this. It's actually the largest issuer in terms of amount. The World Bank issues a lot of green bonds, but they're very small. The European Investment Bank issue a smaller number, but they're much larger. So in terms of. So what is this greenium? So the greenium, it can be defined in two ways. The way we define it, it's the difference between the yield on a conventional bond and the yield on a green bond. So positive greenium, it means that green bonds pay a lower yield. And what we find, and what also other people find, that is either not there or it's very small. One interesting thing that it seems to vary with climate risk. So this is a really preliminary research, but countries that issue sovereign bonds and they are also at risk of climate change tend to have a higher greenium or a positive greenium vis-a-vis a country that issue green bonds, which are not at climate risk. And you see a little bit this in this graph. So this is the exposure to climate change, and this is the greenium, so you see that there is a positive relationship. It's not super strong. The numbers are small, these are basis points, but it seems to be something. Now, the lawyers. So this is a typical language from the documentation of a green sovereign bond. I'll tell you the issue in a minute. But the issue is not relevant because we looked at many of them, and me too and Lee looked at many of them and say, well, it's the intention of the issuer to apply the proceeds in form of placement to finance eligible green expenditure. There is no legal obligation to do so. And there is no legal obligation that this green expenditure will achieve its intended impact. So I issue this bond, but it says, so this is from the Hungarian green bonds, but we find similar things from other countries. So what's another way? So one thing that we feel as more potential that the green, because standard green bond, it works like this. It says, you give me some money, I'm borrowing some money, and I'm using this money to do some specific type of expenditure. I'm going to, build a solar power plant or do something else. So there is kind of allocation of money to something, which in the context of a sovereign is a bit strange because, money is fungible, so it can then go whatever. Even if there was a commitment, then there is not even a commitment, so whatever. One thing that we think has more potential are sustainability-linked bonds. So this is not, I'm not saying I'm going to use the money to do something specific. I spend the money whichever I want, but I'm committing to some target. I'm committing to cutting emission by X%. I'm committing to do something which actually has an impact on climate change. And then the coupon on this bond will depend on whether I achieve this commitment or not. So I'm committing to cut carbon emission by 2 gigatons. If I cut them by 2 gigatons, that's great. If I cut them by more, my coupon will go down. If I cut them by less, my coupon will go up. So this seems to be a better way to do it from the incentives point of view. Okay, so I'm fine. One thing that we think it has a massive untapped potential is the development of a carbon credit market. Let's go back to my thought experiment. Let's suppose that we have a global law that caps the limit to 300 gigatons. The cap emission to 300 gigatons. You know, that is the issue how we allocate them, but let's forget about that for a moment. Then this market for carbon will arise naturally because people will have to trade. And it will be a massive market. It will be huge. And this will and if you think in this world, if you have an allocation which is somewhat fair, we can easily imagine that you have people in advanced economies that need to buy carbon offset from people in emerging economies and poorer economies. And then we'll generate massive flow of money from advanced to emerging economies. And this massive flow of money will not be aid, it will not be a donation, it will not be a gift. It will be a right. I have something to sell. But to do this, these carbon markets need to be compulsory. So I flew here, either the Bank of Finland or UNU-WIDER bought my ticket, but I bought another ticket to go to Beirut last week, and I bought another ticket to go somewhere else next week. And when I book on Lufthansa, I get this thing, do you want to offset your flight? And there are 3 options. It's like whatever offset, so I just bought a ticket for 300 euros, and one offset, it says it costs 2 euros to offset. Then you say, you want to offset a little bit more? It costs 100 euros. And then there was another one, you really want to offset? And it costs 400 euros. And tell me, who's going to pay 400 euros to offset a flight that costs, 300 euros, right? And so it's kind of, everything helps, but until this is compulsory, it's not going to do much. And let me skip this. And you see this, and in a sense, this is what you see when you book your flight on the thing, and you see these 3 options. There are all sorts of carbon offset. And they're all low-quality carbon offset that sort of make you feel good, but they're very cheap. And then there are the true ones, which are expensive. But very few people, these guys who are paying my flight to go where I need to go on Monday, if I tell them that, that I bought, that the flight was 350 and I bought a 400 euro carbon offset, this guy tells me you're nuts. There's no way we're going to reimburse you that, right? So that's the issue. Debt relief from climate. So if we go back to the Tinbergen rule, which is something we were taught at some point in our life, we have instruments and we have objectives, and we should match them. And in general, if you want to provide rooms for climate change adaptation and mitigation, the best way to do it, well, one way would be to have this offset market that would solve the problem in a sense. But in the absence of this, we thought that the best way to do it is the Jerry Maguire answer, show me the money, right? It's with grants. And if the goal is to reduce debt, debt restructuring is the goal. And this idea that we should match the two of them, it works in a few cases, and we discussed a few cases, but it's not the solution in most countries, partly because there is no clear alignment between countries which have debt problems and countries which have high adaptation needs. There is some of it, but it's not perfectly aligned. But also because there is an incentive structure, which I can discuss in the Q&A. I don't have time now. But there are some cases, I'm not saying that this should never be done. There are some cases in which this should be done. And one of my co-authors, Lebdioui, has done this for Belize recently, and has been. But we need to be careful in doing this. What we think it's important is that when a country needs to restructure its debt, we need to include future climate expenditure when we compute the threshold that determines that sustainability. So, and the fund is just changing its DSA methodology to include this. So we need, so climate need to be considered when we assess the haircut that the country needs, the country which is unsustainable. But there is something that needs to come with this. There needs to be some climate conditionality, because if we say, okay, the country needs a bigger haircut because we'll have to, spend money in adaptation, and this is good for the creditor because this will reduce the likelihood on another debt crisis. But then, if the country doesn't do this, people say, well, And the way to do this is to do it by restructuring debt through these sustainability-linked bonds that I mentioned before, which seem to have a proper structure of incentive. So policies. So remember, I gave you 4 numbers at the beginning, 300, 40, 60%, and 6. So let me conclude with 6, because as I said, we don't think that there is a silver bullet, but you need a whole menu of policies, and our menus are 6 components. So, and these are the 6 components. And I don't think they're ranked in terms of importance, but the first one is clearly what I feel is one of the most important. And this is idea to create a mandatory, and this mandatory is the key, market for carbon offset. The second one is the one that I just discussed. Climate risk need to be included in that sustainability analysis at the moment of that restructuring. And this has to come with climate conditionality. And if we do this, there sort of will be a positive market creation externality, because this would lead to the creation of sustainability-linked bonds. But then, of course, we need a system to, verify and monitor the compliance of the condition linked with these sustainability-linked bonds. The fourth one, and this should have gone probably on top, be the first or the second, is the Jerry Maguire story I told you before, the show with the money. There need to be fiscal transfer. These have to happen. So there need to be grants, much more than what we have been seeing and what has been promised. If we want green sovereign bonds to play a role, we need to have sovereign bonds that actually commit, green sovereign bonds that commit the issuer to do something. So we need a better legal framework. And that for nature swaps, they're always the unrealized promise. They have been around for a long time, but there's been very little money so far. Now it seems that there is one for $700 million that is going to happen. But so far, if you tally up all what has been done since, the 1980s, it's been really peanuts in terms of total value. So if we want this to be an important part of the solution, we need to improve their design to make them bigger. And I will close here. Thank you very much. And so this is the sixth.
So thank you very much, Ugo, for really getting us off to an excellent start, bringing together the two big themes of the conference, finance, debt, climate. I mean, this is an humongous agenda that we have. So we're now going to go into some Q&A, and the way that we'll do this is that I think we'll have a question, then we'll get Ugo's response. If we're starting to get a lot of questions, then I'll start grouping them together in the interest of time. But we have enough time now for a good Q&A session. So who's going to get us started off on this agenda? Perhaps as well, if you could identify yourself. I know some of you, not everybody knows each other, so please say who you are if you could. Thank you. Please.
My name is Sanjay Banerji. I'm from University of Nottingham, and thank you very much for this comprehensive presentation. Now, I'll keep my question very short in the sense that is, if I can first sum it up, your whole lecture, the two important points that I thought, one is, of course, the commitment, like either the sovereign or any other entity raises a fund. Okay, that doesn't mean that it will be used for the same purpose that it was assigned to. And also imperfect observability, right? So because this is something, it's not like a project, okay? Because who knows how much, climate pollution has been made by the government X or government Y, and etc. So any sort of finance-related issues where there exists enough incentive for the issuer to use those two aspects to fudge the issue. So what would be, you think, that is a proper instrument or the institutional framework in between the investors and the issuers to make things happen?
Good. Thank you very much, Sanjay. So I'm going to ask Ugo to respond to that one because it's quite a complex question. Many of these debt contracts come down to information issues and information asymmetry. So Sanjay's got us off to a very good start there. Ugo.
Yeah, so this is indeed, a massive issue. And that's why we like, or I don't want to put words in my quarters, I like this idea of sustainability-linked bonds, which have coupons which are related to some measurable outcome. So you could think of, what's the measurable outcome? How much CO2 you put in the atmosphere. So it's not perfectly measurable, nothing is, GDP is not perfectly measurable, but we can get a good idea of that. And then I'll tell the country, look, your coupon payment is going to be linked to how much CO2 you put in the atmosphere, and then do whatever you want. You want to cut CO2 by doing, I live in Switzerland, and next to Switzerland there is France, where there are these people who like degrowth. You wanna, you wanna put less CO2 by becoming poorer. I think it's a bad idea, but you do whatever you want. You wanna put less CO2 by building solar plants. That seems to be a better idea. You do it. You do it whichever way you do it. And I don't care. I'm not gonna write a contract that say you have to put 300,000 solar panel, put 26 wind farm, you do whatever you want. I'm just going to observe something. I'm just going to observe how much CO2 you put in the atmosphere, and that's it. So again, nothing is perfectly verifiable, but this seems to provide the right incentive structure.
Good, thank you, Ugo. So there's a gentleman there. Could you tell us who you are, please?
Hi, Tony, it's Arjan.
Oh, okay, sorry.
It's been a long time. Thank you so much.
Been a long time, yeah.
Arjan Dahan, I work for IDRC. Thank you so much. It's not really a comment on the presentation, but there's some comments came on. I'm saying that because the presentation was fantastic. I think the 6 policy recommendations are plenty for us to get into. The comment is on the differentiation among lower income economies. It came up in my mind a couple of times when you said, for example, most of the debt is now private. That actually differs an enormous amount depending. The lowest income countries are still mostly, the debt is still mostly multilateral, and that has huge implications for any of this policy. And the same goes, I think, very importantly, for the availability of private finance. It is the better off countries that probably have had access to the private markets that now have a different type of problems. I just want to say, it's like, and I'm sure you're going to agree with that. It's like this, and the policy recommendations then are really different for the global south is really very diverse. But thank you so much for a great start.
Yeah, correct. So just to agree with you, so that structure has changed enormously, and again, it was mentioned in the introduction that, in the 80s we had a debt crisis and pretty much everybody was borrowing in the same way, right? From official borrower, from syndicated bank loans. Now we have a much wider menu and of course these complicated things, yeah.
It's interesting, 20 years ago, WIDER held a big conference on HIPC debt relief. In fact, I think, Arjan, you might have been there. And, we're now in a totally different financial landscape in many ways 20 years on, but with a different sort of debt problem now colliding with a climate issue. So, well, we're still vigorous. So next intervention, please. The lady there, please tell us who you are.
Hi, Sarah Columbrander from ODI, and thank you so much, Ugo. That was really interesting and enlightening. I'm going to abuse my position with the mic to ask 2 questions, if that's okay. So the first one is that I was really struck to hear that, to see your graphic showing that debt distress was increasing in low and lower middle income countries before the pandemic struck, before the current energy and food price shocks. And I'd love your thoughts on what the drivers were from sort of 2014 to 2015 when that started accelerating, and how you think that will look now with those additional huge shocks coming down the line and really starting to play out. And my second question, I was also very struck by your comment about the fact that adaptation, mitigation and transition finance should come in the form of fiscal transfers and as grant-based. And I think everyone in the room is very aware that that's going to be one of the extremely fiercely contested topics at COP27 in a couple of weeks. My own sense of that is that adaptation finance, there's a very strong consensus that should be grant-based as a local public good, difficulty of getting a return on investment. But I'd love to hear why you think mitigation and transition finance, which has the potential to generate returns, should best be done as grants, or whether that's just grants to the multilateral system where loans and grants and guarantees and so on thereafter play a bigger role. Thank you very much.
Thank you, Sarah.
Okay, thank you, Sarah. So the first question. So now we divide the world before COVID and after COVID. So my last conference before with COVID, actually I was with Shakira. We were together in Kampala, and I showed this graph, but of course 2 years back, and I actually made the point that you just made. This thing is increasing. And it's increasing. It was increasing already before, so clearly COVID amplified everything. But it was increasing for all sorts of reasons. I don't think there was just one specific reason. There was just, yeah. So I think each country was different now. And then the recent increase, clearly COVID was the big thing. But the point that I made at that point. So let me tell you a story about another conference, which was maybe 10 years ago. And so this was a conference in Tunisia. And there was this debate, do we need a mechanism to solve that crisis? And I was debating in favor, and there was Carlos Primo Braga, which at that point was at the World Bank, which debating against. Then he changed his mind, but at that point he was against it. And and then we had this, was this Oxford thing in which first people vote and then you debate and then people vote again. And in the audience there was a very senior person from a European country, slightly south of Finland, and slightly north of, I don't know where, slightly north of Belgium. Anyway. And this person said, why are we even debating this? We did HIPC, we did the MDRI, now we have the the SDA, what is called this? What is called Shakira, the thing to evaluate the sustainability for low income. The SA, yeah, but it has a different name for low income. Anyway, we have this thing that the World Bank and the fund came up. There will never be that crisis again. That's what she said. And, she was the head of a, very important. And I said, well, I hope you're right. But she wasn't, right? So we keep going to that crisis. Fiscal transfer. So no, sorry, I was not clear. So I meant pretty much what you said. I said that most of the expenditure in adaptation has to be public expenditure, and it is in countries which have limited fiscal capacity and will have to be funded by transfer. Expenditure in mitigation, the private sector can play a bigger role. So I tend to agree. It cannot do everything because there's going to be some transition, some leapfrogging, and and we know that there are issues with private sector money going in developing countries. So we will need something, some form of guarantees. We need something there too. But I meant exactly what you said, Sarah.
Before we proceed to the next question, maybe I could just tease you out a little bit more, Ugo, on the nature of the shocks, which was the first part of Sarah's question. Because, at the start of the presentation, you put up, the view of the Earth as the multiple shocks that we're going through. And of course, one of the issues we're all facing now is, where are global interest rates going? And of course, if we knew the answer to that question, we'd be extremely wealthy because nobody really knows perfectly. But of course, the Federal Reserve and the other central banks are ramping up rates, and that has consequences, particularly if you have dollar-denominated floating rate debt. I mean, what's your sense of the situation that, last year we were thinking a lot of countries on the precipice, Sri Lanka was really going under. Now some people are saying, well, actually Latin America is in a better state of the world, that they've got flexible exchange rates. We're not in that world of the 1980s. We don't have to worry about a sort of Volcker type shock occurring. What is your sense of that? If I could just tease you out on that before we get to the next question.
So thanks. So I think there is some truth in this. I think that the balance sheets are stronger. Country balance sheets are stronger on average than what they were in the 1980s, and that structure is different, and so there are many differences. So maybe let me answer in two parts, since you mentioned this, and this is related to what Sarah asked. So in that conference in Uganda, I was talking about my old research on original sin, on the fact that emerging and developing countries tend to borrow in dollars, and one of the elements which I showed, which was not the only one that led to this big increase in debt, is the typical thing that when you have dollar debt and your currency depreciates, and that was not linked to increasing interest rate because interest rates were still very low, but countries have idiosyncratic shocks, and I was showing that part of the countries with very high increase in their level of debt was due to exchange rate shocks. Recently, the paper is not out yet, but we're finishing it. Barry Eichengreen, Ricardo Hausmann, and I wrote a paper, original sin 25 years later, but it makes you feel old, but anyway. In which we kind of revisited the work that we did in the late 90s, early 2000s. And we see a little bit of this. So if you read a newspaper, they say, this original sin problem is no longer there. And it's true for a very small number of countries. So you have a few countries like Peru, which now they're borrowing a lot in their own currencies. And South Africa is doing it, and Brazil is doing it, but it is really limited to about 20-25 countries. So the other ones are still borrowing very much in US dollar, in foreign currency, but it's basically dollars, with the exception of some country in Central and Eastern Europe. So the movement in the dollar exchange rate will have an effect. On the other hand, many countries are also kind of self-insuring in the sense that they are borrowing and then they have reserves on the other side of the balance sheet, which make borrowing kind of useless in a sense. But yeah, so I think the situation is better than what it was in the 80s, but it's not perfect.
Yeah, okay. So you're giving us some little bit of hope there. So the next question, I think we have Amir, are you raising a hand? Yeah. And then yep.
Thank you, Ugo, for a very stimulating presentation and report. My question was on green bonds as part of your menu of options. It's clearly a growing phenomenon, but my question was, why aren't more countries using them? And what are the challenges that you see moving forward for those of the kind of countries that are more vulnerable to climate-induced debt distress using those green bonds? And as part of the activities that are eligible for it, to what extent is there a tension between activities that are directly aimed at reducing or improving environmental impact versus those that are aimed at improving climate resilience, even if it doesn't mean kind of direct impact, right? Diversifying productive structures around low-carbon industries and these kind of activities. Thanks.
Amir, could you say to the audience who you are?
Sorry. My name is Amir Lebdioui. I'm a lecturer at SOAS, University of London.
Good, thank you. So we'll take that question and then it will be over to Shakira. Yeah, please.
So why don't we see more of them? Well, to answer, number one, this market is growing very rapidly. So then the glass is always half empty, half full. But it is growing, right? So if you look, especially in the case of Europe, it's still very small. So but it's growing. But the answer why we don't see more of them is partly because, again, so I have a normal bond, which it's easy to issue, I know how to do it, or whatever, people are used to it. And then I have to do something which is more complicated, for which I get basically nothing. So the greenium is really, really small. So so estimating the greenium is hard because you need to match bonds, right? You need to find a green bond and a conventional bond which is identical. So a few countries have issued twin bonds, like Germany did. So there it's a bit easier to compare, even though the bonds are not really identical because one is much larger, the other one is much smaller, so you can think that liquidity change, but at least all the characteristics of the bond are the same. And the greenium is like 2-3 basis points. And so why do I have to go and make all these things for 2-3 basis points? So I think that's the key issue. And then the issue, you tell me why it's just 2 or 3 basis points. Well, there are two explanations. So we discussed a little bit the explanation in the report. And one is so we have the Sherlock Holmes story, like the dog that didn't bark. Why there is no greenium? Well, because there is no commitment. So why should I, as an investor, I should give up some yield, even if I care about it, but then you're not committing to anything. That's one possibility. The other is possibility that investors don't care, that they like to say, we like to invest in green stuff and blah, 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 but I'm not willing to pay anything meaningful for it. We don't know what the real story is, right?
Something I noticed, Hugo, from the figure you put up, is how low the issue is in the United States.
Yeah.
Which given, the massive and deep capital markets of New York is a shocker, is it not?
Yeah, so these are just sovereign or quasi-sovereign. Right. Okay. So they're not, if I had put their corporate bonds, you would get much bigger. So these are just sovereign or quasi-sovereign. So these are, the figure that I showed you are just, the government itself, government-backed entities, or local governments. And so in fact, in the US, there is a quite large issuance by local governments. But so there are a lot of bonds issued by local governments in the US, but these tend to be very small, right? So these are the local power plant, the local, water authority, or.
Okay, thank you. So, Shakira, please tell us who you are, and then I'll take the lady in the corner.
From ODI. So in terms of the green bonds, because I looked at it as well, I think one of the challenges too is having a legitimate and credible sustainability brand. And it's not something you do overnight, right? I mean, countries struggle doing their basic public investment programs. So to add another layer of sophistication, there is a transaction cost, basically. And hopefully, as we go forward, it becomes more integrated into national planning, and that cost goes down. So my question for Ugo, because I know you've written on this a lot, is the idea of what countries borrow for. I work in debt management. I'm a fan of debt when it's done right. I think some civil society actors think debt is a bad thing, but being able to borrow to fund critical expenditures is a good thing. So I'm curious, Ugo, compared to the previous crises, do you think that countries have gotten better at borrowing for the right things, especially countries who've been issuing in the international capital markets? And if not, how do we change that? Thank you.
Thank you, Shakira. Are they borrowing for the right things?
You're going to get the economist answer. It depends. Some countries have and some countries don't. And that you see the countries that have are countries which are not in a debt crisis. So but that's a very complicated issue. So let me tell you about approach. So this is the big advertisement of my work. So I'm doing a paper in which I'm trying to estimate public investment quality. At the end is what you have in mind, right? So because if I'm financing to do something, so there are two things which are public investment. One thing is a road to the village where the mother of the president was born. That's a public investment. It's probably not a very productive public investment. And then you can think about public investment that create might be a harbor or whatever, which helps. And they're both they're both in the national account considered public investment. They're both financed with debt, presumably, and one of them will generate resources to repay itself, even if we forget about the environmental sustainability issue, and the other one probably not. So we are trying to create an index of the quality of public investment. There is an index that exists that have been built by people by the IMF, Era Dabla-Norris and co-authors. And the way they built this index was by basically look at the procedure, look at the law, does this country has these procedures. So yeah, there is clearly some value in this. Being an Italian who has lived in Italy and in Switzerland, I realized that laws mean different things in different countries. And so this is useful. So we tried to build a de facto index. And what we did, which is clearly problematic, so we found out that the World Bank does an ex post evaluation of each investment project financed by the World Bank. And so there is this kind of factual ex post evaluation, and there is a score, there is a number. And part of these things is determined by how big the project is, what field the project. Some fields are more complicated, others for. But if I run a regression and I control for all these project-specific characteristics, and then I take out this regression, I take out the residual of this regression, and I average it for country, because the good thing of the World Bank, this has been doing this for 20 years, and I'm observing many countries. So for each country, I have dozens of projects, and I can compute an average, and I use this residual as a measure of the quality of public investment. So I have this index. And one interesting thing, and this is very preliminary, that we have some evidence that countries that invest more, that have a higher level of public investment, and have a low quality of public investment, a higher level of public investment is associated with a higher borrowing cost. So that what does it mean? That I'm spending the money, but the money is wasted, and somehow the market sees this. And in countries that have high levels of public investment, but my index tells that investment is good, the spreads goes down. So, so we're working on this, but this seems indeed to be an important thing.
So let's read the paper. So we have less than...
The paper's not out yet. But
So less than 5 minutes to go, so I'm going to take two questions grouped together. The lady at the very back in the green, and then I'm going to take Marty Hetemaki. And then we'll have to close the session, unfortunately. So please.
Great. Thanks so much. I am Sherry Spiegel from UNDESA. And so, Ugo, I'm interested in that paper as well. That's very linked to a lot of the thinking we've been doing at the UN. So I have two questions. One is just a follow-up on Tony Atkinson's comment of whether countries are in better shape than they were. And because in the 90s, we were in a situation where a lot of countries jumped to what we started calling them emerging markets. And those countries are clearly, seem to be, many of them, in a better situation. But we also have a whole new set of countries that weren't accessing markets at all in the past. And so is it just the point of shock or the point of crisis is just shifting, or are we really in a better place? The second question is about the swap issue, debt for climate swaps. Because of course, economists say, well, no, why put these two things together? It's more efficient not to. But then, as we know, how much money is there really going to be in grants? And if politically, if the first best of having grants and debt write-downs don't happen, then it doesn't make sense to bring the two together because there may be a political incentive to do so, especially when some of the donor countries, in official debt, because donor countries can actually use it for their NDCs as well. So just some to think more. And then if so, because I'm afraid that one of the reasons we don't move forward is because all of us economists are saying, don't do it, it's a bad idea. And the institutions that need to do that need the economists there say, don't do it, it doesn't make sense. So just wondering on your thoughts on that. Thanks.
Great, thank you very much, and great to see you again. Welcome. And then Marty, please. And we all know you, but perhaps you could introduce yourself to the people who don't.
Yes, Martti Hetemäki, and from the University of Helsinki and Aalto University, former bureaucrat. I understood that, on this debt swap issue and that you saw a sort of possibility or opportunity to convert the debt that is going to be restructured to these sustainability linked bonds. And indeed, I think it's and he referred that it would create a market. And just two sort of questions related to that sort of very sort of technical questions, but substantial as well. If a country that sort of converts its debt to these new sustainability-linked bonds would need to sort of pay higher premium if it's not going to achieve these goals. And if for some reason it does worse than expected in terms of economic development, then it would be hit by double whammy. I mean, wouldn't it put this country into a sort of very difficult position? And I was wondering that could a solution be the one that was used in the sort of Mexican debt deal, that the coupon increase would be linked, say, to the economic development of the country. So it would take into account what the country can afford. And second, I mean, isn't the time lag rather long from the measures that the country undertakes to the climate results? So is there a problem in that respect as well? And could one, to deal with that problem, link the coupons to policies, say like reducing fossil fuel subsidies or something like that?
Good, thank you very much, Marty. So I have to ask Ugo to give brief responses to some complex questions, and then we'll be moving to the next session. Ugo.
Okay, so let me start with Shari. So emerging market and leak. In fact, I'm going to tell you you're 100% right on both of your comments. So, but so on emerging market and leaks, yes. So emerging market seems to be better, and that's what we found in this paper with Barry and Ricardo, which hopefully will be ready soon. But you have this leak, which in the past they didn't borrow from market, and now they're borrowing from market, so the crisis might come there. So that's it's 100% right. Swaps. So in the report, it's not here, but we make exactly your point, that maybe swaps are a second best when you consider political constraints. So sometimes, so first best is grant, but if the money is not there, well, you do what you can do with the money. So so I didn't mention this, I didn't have time, but we discussed this in the report. So now Marty's question. So you're right in a sense that if I have a bond in which the coupon increase if I don't achieve my objective, that actually could cause problems because it then could increase the default risk in a sense, and then people will find. So you could structure the bond in another way. You could structure the bond with carrots instead of sticks, right? So you could structure the bond in a sense that you have a coupon that goes down if you achieve the objective, and it's predetermined if you don't achieve the objective. At least, you don't have a negative surprise. Now, the people in the market, they say, we don't like this stuff because it negates our fiduciary duty, whatever. I don't know. It's very strange when you talk with people in Wall Street or in the City of London, because this guy, they did triple CDOs of CDOs over CDOs over CDOs, and then you tell the contingent that, no, that's too difficult, I don't understand. It's like, but whatever. So
briefly, Hugo.
Yeah, I'm gonna 1 minute and be done. The other issue you mentioned, the case of Mexico, so that would be a case to have a GDP index bonds. We have been in Shari and UNDESA, and we are all been preaching of this. It's another thing that is not happening because people in Wall Street, they say it's too difficult. I don't really understand that. And the time lag, this is an issue. But so this is a technical issue, which you have to talk with climate expert, which I don't know. I would be a bit worried to linking it to policies, just because then, again, you have this issue of verifiability, and then you say, well, at the end, the parliament, the legislative is supreme, and you cannot bind the political decision in a country to something that you write in a bond contract, which is and that's why these bonds, they say we make no promise, because at the end, the decision has to be taken by, by the parliament.
Well, I think that's an excellent note to end on. To thank Hugo for a really splendid session, and to move towards the next session to continue the conversation as we're doing so. So thank you very much.
Thank you.
Okay, welcome. Next to the panel on green finance. I see one of the panelists is also here, so please, the other panelists, welcome to join already in the chairs. But I'll introduce you then one by one before your opening statement. But let me first say, so I'm Esa Joki-Wolle, head of research in the research unit of the Bank of Finland, and will be chairing. So green finance is potentially a hugely important new area of finance for both practitioners and researchers alike. Ability to use financial instruments and contracts to facilitate transition towards net zero world could be one of the keys to the solving the climate change problem or challenge. We have 3 excellent researchers in the panel on this topic who will offer their insights from the vantage point of cutting-edge research. While the general goals of green finance are indeed laudable, a closer look makes it obvious that, as is often the case, devil can be in the details. So it matters a great deal how financial instruments are designed and what kind of supporting institutional arrangements are available. So this is why also research on the topic is so important. So let me now turn to the panelists. So I thought that each of, and probably you have been advised already before that, each of you would have 5 minutes, maybe 10 minutes for your opening statements. And then we will discuss, including questions from the audience. So as the first speaker, let me introduce Amir Lebdioui from the School of Oriental and African Studies, London. So prior to joining SOAS, Amir has worked as a fellow at the London School of Economics and led the Canning House Research Forum on the future of trade in Latin America. He was also an affiliated lecturer in development studies at the University of Cambridge, where he also did his PhD. And if I've forgot something important from your bio, please feel free to add and correct yourself. But welcome, Amir, and the floor is yours. Would you like to come here? Or maybe, well, you have the mic, so it's up to you. Please,
Super.
Go ahead.
Thanks. Well, it's an absolute pleasure to be with you and such experts today to discuss the important topic of sovereign debt and green finance in developing countries. The specific issue that I wanted to focus on or address was the context of resource-dependent economies, which is particularly important considering that 2/3 of the developing world are resource-dependent countries. And the 3 main messages that I wanted to share in the 10 minutes that we have allocated, the first one is that resource-dependent countries are particularly vulnerable, right, to the risks of climate-induced debt distress. The second one is, even in the context of a low-carbon future, these countries are not geared towards benefiting from the so-called green windows of opportunity, right, thereby cushioning or improving their climate resilience because of the uneven nature of the industrial geography of decarbonization. And the third message was that we need to rethink green finance mechanisms and the standard policy advice, which has too often emphasized short-term fiscal stabilization, but at the expense of the financing needed for long-term structural transformation to improve fiscal resilience to climate change. So similarly to Ugo, we both kind of have different maps to support our arguments. So here I just wanted to show you 3 maps. The first one showing that the overwhelming majority of the developing world is dependent on commodities, right? Whether mining, agriculture, or fossil fuels. And a few points to stress, and that really kind of, I think, echoes nicely the message that we just heard on who's the most exposed. But here we're showing that those countries that are dependent on agriculture as a source of exports, revenues, and jobs are particularly vulnerable because productivity in the agricultural sector is vulnerable to fluctuations in temperature fluctuations and precipitations in the long term, but also in the short term, and it's already happening, to increasingly frequent meteorological events. Right? So just in the past few years, cyclones, hurricanes, droughts these had massive fiscal effects on countries, including in the Caribbean, in Sub-Saharan Africa, in Latin America, where crops were destroyed and associated revenues with it. Last year alone, it's estimated that climate change generated losses of about $38 billion on the African continent. But even the countries that depend on fossil fuels, right? It's estimated that by the ILO, about 50% of jobs in fossil fuel extraction and fossil fuel-based generation will be lost by 2030. So what does it mean for not only the jobs, but also the countries that depend on those as a source of fiscal revenues? And on the other side, when thinking, I mean, it's becoming more and more obvious that with global decarbonization comes a range of benefits, right? And very often the benefits outweighs the loss in so-called dirty industries, not only in terms of jobs, right? So investing in renewables create more jobs than investing the same amount in fossil fuels. Also in terms of innovation, there are higher spillovers from low carbon innovation than for conventional technologies. But the problem here is that those benefits are not really happening in the same places where you have a lot of the fiscal distress caused by climate change, right? So we have 4 countries that concentrate about 3/4 of job creation around renewables. And that's not even considering the issue of quality of jobs, right? It's just the quantity. But even in countries like Brazil, the problem is that most of the jobs created around renewables are low-skilled, low-paid, temporary jobs, right, in construction, maintenance. And there's a similar story, not just in jobs, but also in terms of innovation, in terms of trade and manufacturing, right? 3-4 countries concentrate the bulk of the benefits on that front. And one thing that I also wanted to show in terms of even when it comes to financing for new technologies, including green hydrogen, the structure in which those commercial networks are planned generate a high risk of renewing all dependencies, right? And especially the resource dependency that I just mentioned earlier. So in terms of raw minerals, critical materials are needed as inputs of low carbon technologies. But even when it comes to hydrogen, it kind of reproduces this pattern of exporting that source of energy towards industrial hubs. Which leads me to then, to the point on how do we kind of rethink green financing mechanisms in resource-dependent countries, and particularly fossil fuel-dependent countries. The standard policy advice has focused on fiscal stabilization mechanisms, especially through sovereign wealth funds. But with work that we're doing with Tony, we're finding that these mechanisms very often don't really prepare countries for what comes next, right? And don't really address the bigger issues, which is the fact that their productive structures are the reason why they're so vulnerable to climate change and why they're not really able to capture some of the gains of global decarbonization. So in a way, it might be more suitable to also think about alternatives, right, including national development banking and green national development banking as a way to generate the financing that is needed to increase local resilience of jobs, industry, and so on. So besides the market-based mechanisms that I think were addressed today, the emphasis there is really thinking about, at the domestic level, but also international level, about how to really rethink productive structures and that link with long-term sovereign debt outcomes. And at the international level, my last message, how am I doing with time?
Yeah. Fine.
This is the last message, is also thinking about, at the moment, most of the international financing or green financing in developing countries tends to focus on kind of reproducing that extraction, right, of raw materials. And it's becoming very obvious, and that's a message that has been shared clearly by people like Carlos Lopez and his colleagues at the Africa Climate Foundation, that there is a role for international investors and financiers to link those investments and green finance with, sorry, that's my alarm. We all wake up in different moods. With an agenda of, opening up pathways for green industrialization, and African policymakers would be a lot more interested in these type of investments that are not kind of reproducing those patterns, but also enabling to link, you know, the kind of dilemma, the climate agenda, with the local industrial development agenda. So I will end on that note and look forward to the discussion.
Okay, thank you very much, Amir. Let me just get my...
Maybe leave it by you.
Yeah. So we could go then straight to the next speaker, who is Anthony Bartzokas, a professorial fellow at the United Nations University's Maastricht Economic and Social Research Institute on Innovation and Technology. So Anthony has worked on financial systems, corporate investment, and innovation dynamics. Particularly, he also has obtained real-life exposure to investment decisions and financial markets during his tenure as executive board director at the European Bank for Reconstruction and Development. So very happy to have you with us today, Anthony, so please.
Thank you, Chair. What I would like to do today is to talk about green finance and green innovation. And we have been asked to stick to 2 slides. This is what I'm going to do. Basically, what I would like to do is to start from operational experience and see if we can draw some interesting implications for policy, but also research. So it will be a practical presentation more from a private sector perspective. So I will highlight a few points on green finance and a few points on green innovation, indeed, the relevance between the two. Let me start with green finance. Basically, I would like to convey a few concrete messages. The first message is that we keep talking about green finance in terms of green bonds. I will urge the audience here, but also the policy community, to look more on, say, low profile, below the radar applications. Energy efficiency, trade finance are very important issues related to green finance. We tend to overlook them, and this is a mistake for policymakers, but also research. My second point is about green bonds and how it's connected to commercial markets. If we look at what happened in the last 20 years of the expanding use of green bonds, something very interesting emerges, and that is the relevance to commercial market trends. The most important is scale. Green bonds have been facing a threshold of, say, 500 million, and beyond that, below that, it is very difficult to activate them. Similar issues we can raise of other aspects of commercial markets related to green bonds. Now, let me come to the area of what I have been doing in the last 10 years, which is development finance. Development finance institutions have played a very important role in the diffusion of green finance products. First, in the below the radar applications, as I mentioned before, but also in terms of green bonds. First, when critical stages of the market were in place, they stepped in. But also, I would say, looking forward, the development finance institutions have been playing a prominent role of stamp of approval. And as the market becomes more critical about impact, the presence of development finance institutions in structuring green bonds becomes even more important. And this is something that we need to keep in mind. 2 final points on the green finance dimension. My first point is about international coordination. It is very important to have global banks, but also other global players at the table in a kind of global coordination context, because spillovers can come anytime, and that can undermine and disengage from a green finance mandate and process. My final point is, I come back to what Kunal was saying at the beginning. If indeed debt markets are moving in the direction that we all know, then we need to prioritize green finance processes, but also policy initiatives, because the market will become more difficult, and these guys will pay the price. Now let me turn to the innovation side, green innovation. I think if we are serious about the Paris Agreement, we need to talk and carefully study green innovation patterns. They are not very promising. They keep moving in, say, the end user perspective, but more fundamental innovation is not progressing the way that we would like to see. The point I would like to make is the following. If we think of green innovation in a kind of nexus from green finance to green innovation, I think we are making a mistake. Because the whole process is about a triangle. It's about risk capital, green finance, and green innovation. And we should be looking at this triangle in a kind of holistic view if we want really to produce decent policy recommendations. Is this relevant to developing countries? Is this relevant to emerging countries? I think it is, because whatever resources developed countries will invest on R&D, we need to have, say, complementary activity, innovation-related activity in developing countries. And this is a very important dimension. Is there a role for development finance institutions in this process? I think there is. And we need to move from development finance objectives as a scale priority to development finance priorities and policy objectives as a quality priority. By quality, I mean that they can step in and engage and trigger the risk side of the triangle that I was mentioning before. My final point, Chair, is about intermediate and bridge technologies. If we did start thinking about green innovation as part of this triangle of green finance, risk capital, and green innovation, in the middle we have the need to better understand at the sectoral level what a bridge technology, what an intermediate technology is for a developing country. Take, for example, gas and other applications that African countries have been protesting about. We need to understand what kind of solutions are practically important for these countries, to what extent innovation can play a role in this process, and how we'll finance this process in this entirety. I'll stop here, and I'm happy to take further discussion on these issues in the Q&A. Thank you, Chair.
Okay, thank you very much, Anthony. And then we have Shakira, Mustapha. Welcome. You are from the Overseas Development Institute, ODI, London. Shakira is an economist with expertise across a range of public finance issues, including budget and expenditure management and debt management. Earlier, she has worked with the Ministry of Planning and the Ministry of Trade and Industry in Trinidad and Tobago, supporting various public finance reforms and the development of economic diversification strategies. Shakira holds a master's degree in public and economic policy from the LSE. So Shakira, welcome. The floor is yours.
Can you guys hear me? Yeah? Cool. Amir, this is the first time I saw a map and saw Trinidad and Tobago on the map. So thank you very much for that recognition, despite being a dot.
A map, so I can't take the credit.
But still, you presented it, so thank you. So good morning, all. It's my pleasure to be here today, making my first debut presentation post-COVID. It's all been Zoom since then, so apologies if I'm a bit rusty. So originally, when I was asked to participate in this panel, I was like, ooh, I'm going to talk about debt for climate swaps. Then I saw I was following Ugo, and I thought Ugo is going to say everything interesting already. So what next could I say? And then I saw Amir's presentation, and I was like, oh, there's some brilliant work that we've been doing at ODI on country platforms. Now, I'll explain what that is, but it's basically an innovative model for providing and delivering climate finance from developed countries to developing countries. Now, for those who have heard about it or who haven't, at last year's COP in Glasgow, the Just Energy Transition Partnership from South Africa was the crown jewels. This partnership was, which is known as JETP for short, it represented the first step towards creating a country platform for climate action. In these 10 minutes, I'll explain what exactly is the JETP, what is a country platform, how are the two related, and ultimately, why are they important? I draw heavily on an ODI paper written by my colleagues and me called Country Platforms for Climate Action, Something Borrowed, Something New. Of course, 10 minutes is not enough to cover the entire paper, and for those who are interested, I strongly recommend reading it. So what exactly is the South African Just Energy Transition Partnership? Well, it's a partnership between the governments of South Africa and a handful of G7 countries, specifically the UK, US, France, Germany, and the EU, with the latter forming the International Partners Group. This group of international actors have pledged an initial 8.5 billion to support the government of South Africa to decarbonize its energy sector. Apologies, I'm recovering from a flu. It's not COVID. yeah. So what is noteworthy about JETP is that it's a mutually beneficial partnership that links domestic political priorities. On the right-hand side of the slide, in South Africa, their priority is job creation, economic growth. The unemployment rate is one of the highest, about 32% last year. It also, on the other side of the table, is international climate goals, specifically the Paris temperature goals. This JETP intends to link both of them in a very direct and explicit way. For the international community, given that South Africa is one of the world's most carbon-intensive electricity producers, helping the South African government to accelerate the retirement of its coal-fired power plants can be a step in the right direction for reaching these temperature goals. From the point of view of the South African government, this partnership enables them to pursue critical reforms to transform the country's electricity sector in order to improve its reliability and cost effectiveness in a just manner. Currently, as you may be aware, the sector is weighed down by a heavily indebted state-owned power company, Eskom, that frequently relies on bailouts from the government. I think last year was about 1% of GDP, while the net losses of Eskom about 0.4% of GDP. So on top of that, electricity tariffs are rising and there are frequent power outages. Because of this, the sector itself is a huge impediment to growth in South Africa. However, while reforming the electricity sector has been a priority for the government, it's been complicated by the country's long-standing dependence on coal. What this means is that there's a lot of patronage systems and jobs that heavily depend on coal revenues. The partnership therefore represents a window of opportunity for the South African government, providing a potential catalyst to enable key interventions in support of more rapid decarbonization. The idea being that how a lot of international public finance will be helped to compensate and support the losers from the early retirement of the coal power plants. Many of the details of the JETP are still in the process of being developed, with the South African government and the international partner groups currently drafting the investment plan, as well as the related financing package, which, to be honest, is most likely going to be concessional and non-concessional loans. From what I've heard, it's going to be released at COP27, but a version has already been leaked as these things happen. And in this plan, it outlines different rules for public and private sector funding. The JETP financing package presents an opportunity for MDBs and DFIs to experiment with novel financial mechanisms. Reacting to pressure to take action against climate change, global policymakers have urged MDBs and DFIs to take greater risk in their clean energy investments in emerging economies. What does this mean, right? Is that DFIs and MDBs need to aim to develop and create investment opportunities rather than just investing in near market-ready opportunities. This requires greater focus on pipeline development, pioneering, demonstrating investments, and early-stage investments, which in turn requires greater use of high-risk capital. Ultimately, DFIs, to be part of this to make a significant impact on this transition, they need to change what, where, and how they invest. While the JETP is still in the process of being operationalized in South Africa, its announcement has raised hopes of similarly ambitious deals being struck in other carbon-intensive emerging economies, Vietnam, India, and Indonesia, as well as for other aspects of climate action, such as adaptation and resilience. What I want to emphasize is while there may be scope and appetite for these similar deals, it's neither feasible nor recommended for the South African deal to be copied and pasted across countries. These partnerships are country-driven and rely on highly individualized consultations between host nation leaders and partner governments. At the same time, the JETP and South Africa's emerging platform highlights some key features and functions that are likely to be desirable across country platforms. Where did I do the slide? Oh, sorry. Right, so in broad terms, a country platform is a government-led, multi-stakeholder partnership that is used to attract and coordinate international public finance in support of common goals. More simply put, it's a vision of how international cooperation on development and climate change could or should be organized at the country level. There are three common functions that a country platform inspired by the JETP model is expected to perform. First, it needs to coordinate national politics and international interests behind a shared plan or goal. Second, it needs to align international concessional finance behind that shared plan. And third, it needs to develop a genuine step change, deliver a genuine step change in climate action. But, that sounds great, right? But what perhaps is more important is how will a platform actually do this? First, it will need a credible political agreement between the host government and international partners to address an issue of shared concern. This provides the basis for a national policy response and for the international community to release significant additional resources to accelerate the necessary reforms. The political agreement essentially signals commitment and unlocks financing. Second, it requires a programmatic approach to financing to target a specific problem. This requires having a credible plan, effective coordination structures, and a means to pool financing from different donors. It is hoped that by having this in place, it will help to avoid the incoherence and high transaction cost that currently characterizes the majority of the climate finance landscape. Third, it would involve strategic support to tackle barriers holding back projects and finance for private sector investments in low carbon and clean energy projects. A country platform like South Africa's aims to shift parts of the economy onto a less carbon intensive or more climate resilient trajectory. This requires scaling up private sector investment in clean energy and other climate solutions. MDBs and DFIs are not responsible for changing domestic policies, and their investments are likely to have little impact without corresponding energy sector regulatory reform. In South Africa's case, it's very clear that the achievement of JETP hinges on domestic reforms that maximizes the effect of public spending and induces the flow of private capital. I would like to conclude with one related point, and that is that it's 8.5 billion. Given the size of South Africa's economy, their revenues, it's a relatively small amount. I think ESCOM itself estimated that it requires 27 billion to kickstart the shift away from coal-fired generation in coming years. A South African university estimated that to create a clean energy infrastructure, the government needs 250 billion over the next 3 decades. The significance of JETP is not its size, but the substance. It's an investment plan and accompanied by a set of corresponding reforms that South Africa must implement to maximize the package's impact. And ultimately, that it is hoped by doing this that it will help to create a pipeline for private sector investment. A recent IMF study noted that for South Africa, the greatest obstacle to transforming its energy sector has been insufficient reform rather than a lack of finance. And for me, the JETP, it's therefore a step in the right direction. It's a new approach, and yes, that involves risk, but the status quo needs to change, and that's an attempt to do this. Thank you.
Thank you, Shakira. Thank you, everybody. So we are soon ready to move to the Q&A also with the audience, but while you are possibly still thinking about your questions, so let me start by one myself to all of you, if you wish to express your views. So what I often hear in the context of green finance and the reallocating investor capital from browner to greener projects. So the question is the quality of information available, something like ratings that could measure the the degree of greenness of investments and so on. So what's your view in this regard? And of course, this is something that could vary a lot in different parts of the world. So how far are we with this? What are the challenges? What should be done? Are you happy with the situation or not? Who would like to start? Anthony, perhaps.
I think there are two aspects in this problem in a way. One is the financial aspect, and then the second one is the impact aspect. Because, you know, if we are talking about green finance and investment from a green finance perspective, even the financial aspect could have some weaknesses for the banker who is assessing the whole process. And then at the end of the pipeline, you have the interested parties who look at the impact of this process. Is there a way to tackle these information asymmetries and these problems? I think there is a role for regulators in the way the whole situation is being monitored, but there is also a role for, you know, peer interaction, because especially when we have banks, global banks, involved in complex transactions, we need to look at green finance in a kind of holistic view. It's just not the product itself, it's a network of transactions that is evolving through this process. So I'm very skeptical about the current criticism about impact investment, if we're measuring correctly and all that, because it's really about the surface, and it's not going below that to the real problems of how you can assess green finance from an impact perspective. So I would say there is a role for the regulators to trigger a more in-depth analysis of green finance.
Okay, thanks. Amir, would you like to add something? Or?
My point wouldn't be so much on the, so you mentioned kind of level of readiness for this type of investments, but I was going to turn more towards the side of readiness in different ways, apart besides, you know, credit ratings and so on, but readiness in terms of local skills, infrastructure and so on, and going to the theme of industrial policy. But I don't know if this is maybe for another question or worth discussing now.
I mean, go ahead. If
so the part I'm mostly interested in is the kind of discussion around green industrial policy, right? Besides the alongside market-based mechanisms, but this is the way to ensure that those kind of transitions are not only about you know, feasibility, but also fairness and politically attractive. And in many developing countries, the big challenge is not just deploying renewables, because in many ways, especially in Latin America, right, renewable energy deployment has been a lot more successful than in Europe or North America and most other parts of the world, right? But the challenge is how to make sure that this type of investment, that this type of financing is one that actually generates local value and multiplier effects. So in that sense, I think that there is a lot of work to do in terms of, you know, kind of local readiness, in terms of skills preparation, because you see green industries that create green jobs require green skills to be able to capture those jobs. And a lot kind of clarity of information sharing and vision, right, in terms of how those investments are integrated with the rest of the country. So I think a case that comes to mind, Namibia, right, which has a very ambitious green hydrogen plan, financing that seems to be available for it. But the whole question that arises, how is this connected with the rest of the economy and people who actually suffer from energy access gaps, right?
Yeah. Thanks. Shakira.
So, I mean, the concept of a just energy transition, it's not something that's fixed or defined, right? So I think that's why for South Africa, a key part of this partnership is doing the investment plan, so that people will have an idea of this is what we in South Africa think a just energy transition is. This is what the areas of potential projects will be, and this is what, you know, we want to match different financing to. So I think information is very key, that signaling of, you know, we have a pipeline, or we have an idea of what a pipeline will look like. I mean, some banks and some actors have said, we're not going to finance coal at all, but what about the transition? And that transition financing, it's less sure, right? And I think there's appetite, and there's a role for information to shape of what transition looks like and how it should be financed. Yeah.
Okay, great, thanks. So now questions from the audience, please. I think there was a, please, and if you can introduce yourself also briefly, thank you.
All right, thanks so much. My name is Michael Danko from UNU-WIDER. Just a bit of a follow-up. I am very much interested in your, what you call it, the views on green finance and the new growth path for low-income countries. What are your thoughts on that? Because, I mean, there's that fact that the raw material footprints for many of these low-income countries have been going up over time. It has its own implications on the carbon, what you call this sinks, right? The forest reserves, and on and on. So clearly, the need to look into a new growth path, look into new jobs, be it blue or green or whatever. If you have any thoughts on that, that'd be good. Thanks.
Thank you. Who would like to start?
I would like to offer a couple of comments. First comment, I think predictability is very important. Because when you talk to bankers, the first issue they will raise at this point, at this juncture of time, would be predictability. I mean, they would argue that because of geopolitical reasons, all that, all the agenda about green is being redrafted. So, we need to introduce some predictability in order to have decent financial decisions. This is the first thing. When it comes to specifically developing countries and least developed countries, I would argue for the low-level energy efficiency and green finance solutions, because this is something that the international community keeps ignoring. I think it's, if you look at it from the appropriate technology point of view, it makes a lot of sense, and we need to emphasize more and allocate more resources and capacity on that. Let me add one other point, which is related also to the previous question. When it comes to policies for green transition, I think capacity to upstream investment projects is very important at the country level, especially for least developed countries. And this is something that we need to, put up front in a way.
Thanks.
So, yeah, to answer your question, maybe two more specific things in terms of new green financing mechanisms. So I mentioned earlier the role of national development banks, right? And nowadays you see a switch in some countries where national developing banks in developing countries take a proactive role in providing kind of green financing needed to scale up, right, green projects and localize industrial benefits. So Brazil has an interesting case, right, with BNDES, who played a key role in actually can take a lot of the credit for the successful emerging wind turbine manufacturing sector, right, where they were providing competitive credit, competitive rates, below market rates for bids that had higher local content around, wind energy projects. And the other side is, you mentioned kind of blue-green economy. One, some work that I do is on biodiversity-based innovation. So obviously, as part of a green transition, it also implies that a lot of the world's remaining biodiversity, which is in the developing world, would need to be protected, right? And to date, this is something from the whole world benefits from, right? Clean air, carbon capture services, watershed services, but no one really pays for it. And in that context, there are new financing mechanisms that have emerged, including payments for ecological services, right, where governments pays landowners who adopt sustainable forestry management techniques, but the problem is they still remain at the government level, right? It's not the international community that often pays for these services sometimes, and the other side is that biodiversity has a lot of value, ecological value, but also as value as a source of innovation and information, as a source of information and inspiration for innovation. And very often that value is being captured in a handful of countries, right, in North America, Europe, East Asia, and not necessarily locally. So if we kind of rethink about the different ways to localize some of the value of those green assets through blue or green economy measures, it's a different way to generate funding and financing for the green transition.
Thanks. Shakira, would you like to? You're fine. Okay, thank you. I think Kunal had a question there, please.
So I had a question. So I'm Kunal Sen of UNU-WIDER. I had a question for Amir and a question for Shakira. That's allowed 2 questions. But Amir, the question about industrial policy, green industrial policy. So if you look at the past, the history of industrial policy, it's a very mixed record. So East Asia did pretty well with industrial policy, but Latin America, Africa, South Asia did pretty poorly. There may be exceptions. So, and therefore my question is that given the green industrial policy needs more information requirements of selecting winners, exactly as you heard from Hugo in the morning, how can we ensure that green industrial policy can avoid the mistakes that happened in past industrial policy? That you pick winners without knowing exactly the question of where they're investing, how do we check what they're investing, and so on, which was always a problem with the past industrial policy, will be more of a problem with green industrial policy. And so do we really want to get to a situation where with green industrial policy, we see the same problems of cronyism and state capture and so on, which we have seen many examples of that in the past. So my question is, can green industrial policy really work? Shakira, my question is back to what you said of South Africa. And it really poses very interesting challenges that South Africa is facing, that they're shutting down coal plants and they think about renewable energy. But then the question I have is that what about those workers in those coal-fired plants or in one part of South Africa who are going to lose their jobs in the near future, who are of a particular demographic group, they're fairly old, they are skilled in particular industry which will not be, they cannot transfer the skills to some other industry. What can we think about in this just transition for those who could be losing out? How do we compensate them? And how can we make sure that this doesn't become a political cost for countries going through this kind of transition? So my question is that I think, what are the political implications of just energy transition we need to think about in the future?
Thank you. So we start with Shakira on 2 questions potentially.
Sure. Not to steal your question, but like I've been looking at green industrial policy as well. And to me, the problem with past countries and industrialization is that the challenge is also when you realize you have a loser, how do you stop supporting the loser? So how do you create those systems and checks and balances and retain that autonomy of you're working closely with the private sector, but that doesn't stop you from withdrawing support when it doesn't work. But I'm sure Amir will get into that in more detail. The workers in South Africa, I mean, yes, the concept of the just energy transition is just, right? But the investment plan, I haven't seen it as yet. I'm looking forward to see what this social justice component is, because that's the idea, right? That there are winners and losers, and how do you compensate these losers so that it reduces vested interest, and this could actually have a chance of progressing. And some people might be able to be retrained. Some people might be compensated through social protection mechanisms, but some people will fall through the cracks. And it's a very important question, and I haven't seen the proposal as yet, and something I'm really looking forward to seeing, hopefully at COP. I will say, like, the world is looking on, right? Because India, Indonesia, Vietnam, they want to know, okay, how did you actually do this? And most importantly, did the international community provide you with grants to help you cover these things that the private sector won't do, that you can't borrow for because that's not going to generate returns to repay those loans? So I think it's a big unknown right now, but it's a key part of the partnership, and we expect to see more about me writing more about it very soon.
Thanks, Kunal. This is a very important question. So in many ways, we are witnessing a green revival of industrial policy, right? Nowadays, arising from the increasing acknowledgement that those policy tools are needed to address climate change, because the kind of changing consumption requires also a changing of productive structures. And even in the US now, the term industrial policy is being acknowledged for the first time in decades, but it's only in the context of climate change, right? It's about solar cells and so on. And green industrial policy, in many ways, it's industrial policy, in the context of low carbon sectors, including similar tools, but not always. But you're right that some of the old issues of industrial policy, it would be a lie to say that they don't exist anymore. And I think we see that in the practice of it. Many countries, especially in the African context, when they've adopted green industrial policies, it tends to be limited to local content requirements for solar panels. And in many ways, that's probably one of the worst types of green industrial policy that you could do, because it's very difficult to export solar panels. It's a very competitive market, and the technology is also changing so fast that you become at risk of technological obsolescence. And there's been research showing that from about 30 countries that have implemented local content requirements in solar cells, only 2 have managed to export them, right? China and Spain, and these are countries that leverage pre-existing capabilities in different sectors, especially electronics, towards solar cells. And the other issue is that not all green industrial policies are necessarily green, right? Because we think about the carbon footprint, but then there's the whole problem of material footprint. It's not just about producing more things. However, despite those limitations, it's important to not throw the baby with the bathwater, right? And there are many ways in which green industrial policy is not only necessary to move forward with low carbon production and innovation, but in many ways it's about sharing benefits more equally, right? Ensuring that countries that are resource dependent, who cannot export the same products that they're exporting now in 20, 30 years because of consumer demand or because of climate agendas, that they have something else to produce and other sources of foreign exchange. And the other thing to remember is that the risks still exist, right, in terms of, there are ways to mitigate them, and I think some things we can learn from history in terms of performance requirement, learning how to fail, right, and from previous mistakes and adapting and monitoring and evaluation. But still, it's true that there are always risks, but it's important to remember that the costs of not doing it are higher than the risks of industrial policy, because you see that for resource-dependent countries, the future with the status quo is very clear, right, and it's extremely bleak.
Thank you. Anthony, would you like to add something? You're fine. Thank you. I think we had a question, at least there in the middle, so please. Yeah. That's right, yes. Yeah, it's coming.
Thank you so much for 3 great presentations. The politics are much more important than this, right? We just need to think about, Europe, the farmers in the Netherlands, the truckers. I'm a cyclist in North America. The truckers in Canada, as like they've traumatized us, right? And the truckers started with, the concerns about the oil industry in Western Canada, right? So the politics are absolutely important. The reason I'm saying is the research that we produce it's really important to take account of that, right? Because we're fighting misinformation, effectively fighting those politics. So it's really important. I actually had a very specific question, it's completely different to Anthony. I was very glad that you raised the issue of, it's a great presentation, the issue of technology, then the finance of technology. And you mentioned patents, and I was just wondering if you have any idea whether the intellectual property regime that we currently have, if we think back to the worst disaster that we've seen around the vaccines, how that was monopolized, almost monopolized, and was publicly funded, but did not become a public good. Whether you think that plays any role in the needed green technologies, and whether this is a topic of research. I'm looking at Kunal, right? A topic of research that perhaps we should integrate into those discussions. Thank you.
I have a longer slide deck with some slides on patents and all that, and I'm happy to share. From that set of slides, what emerges is that when it comes to green innovation, we have seen a plateau since 2010, and the people who try to explain this trend in a way, they say it's primarily because of market trends, because they see that green innovation is going down, but it has stabilized and increases slightly when it comes to end user. And there, the example they give is the electrical car. Yeah? because a market was there, it was booming, and innovation was pulled in a way. So that would be my my answer to your question. And I'm happy to share the slides who demonstrate that.
Would you have any views to add here? You're fine, thank you. Please.
Hello, Sarah again, and with two questions again, I'm afraid. So the first one is to Amir and Shakira. It was really great to hear you speaking about the jobs, because the political economy of this is so key. It actually reminded me of the story in the late 2000s where China sent a delegation over to Germany to ask advice on managing the transition out of coal. And they found that Germany only had 20,000 workers in coal, and the delegation went home because they have 5.3 million people to get out of coal jobs, which is coincidentally the population of Finland. So the first question builds on what Kunal was asking about green industrial policy to Amir and Shakira, which is to say, even if you got green industrial policy right, what are the real prospects for low and lower middle income countries to get onto those supply chains now, given that the US and the EU are setting up these protectionist arrangements with the Inflation Reduction Act and the Green Deal, that China dominates markets and India is trying to do the same domestically? Is there a real chance for a Mozambique or an Indonesia to be a part of that story? And the second question is to Anthony. It was really great to hear you speak about a wider range of finance instruments for climate change, ESCOs for energy efficiency and so on. And I wanted to explore an idea that hasn't been mentioned today, which is that the conversation about debt for climate seems to be about debt for real world emission reductions or increases in solar and so on. I wonder if is there a scenario that you can see where debt or other instruments that you mentioned can be linked to changes in spending? So debt in return for fossil fuel subsidy reform, increases in carbon pricing, are those mechanisms used elsewhere? Could they be transferred to the climate space? Thank you very much.
Thank you. So maybe we start with Anthony, please.
Yeah, my short answer is yes, because that's why I argue that we need to understand better the mechanics of how these policies and initiatives are being implemented. And then we can build, say, the data sets that are related to efficiency in these processes, and then you can link it to transactions in a way. Because take, for example, energy efficiency, the thing you discussed before. If you go to real life, we have interesting policies being implemented at the bank level. They have data monitoring how effective these policies are. So you can link this performance in a way to whatever instrument you want to structure. So my idea is that when you start from below the rather low profile green finance potential applications, there you have already platforms that are being implemented. You have data demonstrating to what extent something works or not, and then you can link it to transactions in the market in a way. And this is the way to leverage real life facts with forward-looking markets in a way.
Thanks.
Thanks for your question, Sarah. So basically in the context of low middle income countries and how to address the question of jobs and green industrial policy, there's still, you're right that policy space is constrained in many ways. However, there are still different types of opportunities for these countries, but with caveats. I think one of the big issues that I think you're hinting on is the fact that something that is happening in different sectors, but in low carbon sectors in particular, the rate of innovation is very fast, and there is so much uncertainty regarding which technologies are actually going to scale up and which ones might not. And in that context, it's very difficult for developing countries to localize some of the supply chains, right? Even though there are attempts, but even when it comes to lithium-ion batteries, there's so much resources being put into batteries that use different supply chain that are not with lithium, but hydrogen-based batteries or phosphate-based, and same with solar panels and many other technologies. So I think that my opinion is that when it comes to those kind of industries, developing countries, especially those with low capacity or those where there is a high opportunity cost of those investments, there might be better or safer investments downstream as opposed to upstream, because you don't want to localize the supply of goods and services for particular technologies, and then the technology changes in 10 years. And same with hydrogen, right? Electrolyzing technology is changing very fast. But when it comes to once you have, let's say, a source of cheap, clean and reliable energy, it opens up many different areas, some of which we know about, but some of those we don't even know yet what will be the next opportunities. That includes technology services, right, that are technology intensive. And that can be localized if you already provide this kind of energy, and where energy is the most expensive input. But also things like green steel, green aluminium. And then second point related for countries like Mozambique, you said, is the whole thing about transportation. That links to your point about information and data sharing. So far in investment decisions, the emissions from transportation are not always fully understood or taken into account. But in many ways, does it make sense to ship, let's say, hydrogen from Southern Africa so that it can be turned into green steel in Japan and then sold back in Saudi Arabia? Right, that has a cost, not only commercial, but also environmental, right? Environmental costs of shipping. So if you take that into account, sometimes does it make sense to localize some of those industries or shorten some of that supply chains? And same with things like wind turbines, where it's so massive that transporting has a huge environmental cost. And it's happening particularly in Latin America, where all of the raw materials and goods and the demand is in Latin America, but they're all shipped to China and re-imported as wind turbines. So this is and obviously a regional supply chain is not easy to build, but from an ecological, but also development point of view, is probably what makes a lot more sense.
So just building a bit on what Amir said, as I said in the presentation, like the state of the electricity sector in South Africa is a huge obstacle to growth. So just helping to make that better will help create jobs, and it mightn't be in, some of it will be in renewable energy, but will be also outside the energy sector. And bear in mind, it's unemployment rate of 32%. Coal mine workers, I think it's about 120,000 workers in South Africa, in the coal mine, as well as in the aging power plants. The potential for job creation from this transition is significant, and some people might say that itself is just that creating these jobs will create more opportunities compared to the people who will lose out. Of course, the people who lose out will feel differently. The good thing about the South Africa model, I would say, it's very consultative. It didn't start at COP26. Since 2015, this idea of just energy transition has entered their rhetoric and the development agenda. I will say, too, it's the forward planning and thinking, okay, these are the industries we want to create. How do we get the younger generation having those skills? And the idea is that that is what South Africa is trying to do. A lot of countries have tried it in the past, building those skills, but it hasn't materialized in the way that it was planned. But the idea is that having a clear agenda and a plan and a set of reforms to back that up, it increases the probability of these things actually leading to a positive outcome. And I think there is reason to be hopeful. Right now, they think in South Africa's case, they're talking about the manufacturing of electric vehicles and green hydrogen, which I know less of, but I think that there is real potential for job creation. Yes.
Thank you. So we still have some time left. I have two questions, and I think that'll be it. So please go ahead first, back there, and then.
And thank you. My name is Morina. I come from Kenya. My question is to Shakira. I'm just curious to know to what extent this partnership, if there's any possibility of it being extended to other countries, and the practicability of it. Plus, we know that South Africa, I think the focus is more on the production of coal. But how about these other climatic challenges? Is there any possibility that this could be extended to cover that? Thank you.
Thank you. Can you hold on for a second so we can combine with the other the last question now, so Tony, please.
Tony Addison, Copenhagen and wider. So my question is linking up the green agenda with the debt question, which is, say I'm a Minister of Finance and I say basically, well, I really like your, ideas around industrial policy and the just transition and job creation, but these are really at most medium-term, long-term gains to the economy. And, next month I have to find $1 billion to repay my debt, service my external dollar-denominated debt. And at the moment, all I have got is fossil fuel earnings, coal in the case of South Africa, or oil in the case of Venezuela. There are some powerful incumbents in the sector. The national oil company is saying, well, we're very viable. There's a very good market for oil and gas. There's still a very good global market for coal. We can sell this stuff. So my short-term problem is I need to service the debt. Can you help me out on this? What's your response?
Thank you. So we'll start with Shakira, and then everybody can address Tony's question.
So the idea of the partnership, like South Africa being extended to other countries, that's definitely the current intention, targeting other high carbon emitters in emerging economies like India, Indonesia. But in our paper at ODI, we make the case that it's climate action, it's not only mitigation. So there is a potential of using this model, the political agreement, having concessional finance backing a shared plan and vision to deliver something that's a definite change as opposed to a marginal improvement. So there is that potential, we think, for adaptation and resilience. How that would look, it hasn't been done yet. There's a lot of appetite and a room to help develop a framework of what this may look like. So I think, yes, it is a possibility, and it's something that we at ODI plan to do more work in as well. I will say it's related to the fact that climate finance, the project financing approach, it hasn't produced the results that we want. It's messy, it's costly, you can't easily access the finance. So really finding a new approach to work with countries to support their priorities. That's the goal of this platform approach. In terms of Tony's point, which is, yes, in terms of the short-term treat of, I worked in the government and I advised governments, and you want to pay salaries, you need to service your debt. And a lot of these things are very medium to long term. So really, in the case of South Africa, that's why it really has to start with that political agreement in terms of that buy-in from the top. If that's not there domestically, it's not going to happen because there's too many interests against it, and those interests are well organized, right? In the sense of South Africa, Eskom debt is such a huge problem, and it can't go on, right? And they recognize that's having an adverse effect on their own public finances and on economic growth. So that's why it's a win-win situation there. In other countries where you may not have that incentive, that's the political dynamics are different, and really what will the international community offer to sweeten the deal? And that's still to be decided, right? I know in Ecuador a long time ago, they had that deal like, you leave the oil in the ground and we'll pay you X amount of money. That never happened for a variety of reasons. Because, it's how does international public finance using that to pay off your debts is not going to fly. But how do you improve the international architecture so the countries could restructure their debts in a more timely and efficient way, and where this, as Ugo was saying, like linking those things to climate, and I think that's the way we need to go. It's going to be messy, it's going to be tricky, but that's definitely what we have to do going forward. I'll stop there.
Thank you. We're actually pretty much done with our time, but would either of you like to add to?
Yeah, I wanted to extend a bit your question to another aspect. One is debt service, the other is fresh capital. Your minister is interested about fresh capital and goes to London or New York trying to persuade people in the banking sector to get interested in his country. The first response he will get will be a cynical one. When he starts talking about green strategy, etc., the banker will interrupt him and say, this is just noise, I'm interested in returns. And then you have the more sophisticated type of bankers. They will raise two issues. One is risk, the second is aggregation. So I think from an academic point of view, the challenge we have, and I'm trying to be a bit provocative here, the challenge we have is to see how we can integrate risk and aggregation in a kind of bottom-up policy from the endogenous needs of a developing country. Because even sophisticated bankers, this is what they are looking for. And if indeed fresh capital is in need, we need to try to accommodate these responses in a way.
Tony always asks the tough questions. But in that context, the point I could add is the idea of thinking about those pathways between short-term needs and long-term objectives. Right? There's no one way to a low-carbon future, and obviously sometimes there are tensions, but there are also ways that short-term objectives can be leveraged. Even when thinking about fossil fuels, right? There are different ways in which you ask the question: does that short-term extraction help long-term productive capabilities, let's say in blue hydrogen, and then transition towards green hydrogen? And that also addresses the point of skills and jobs, right? And in many ways, the people that are working in coal or fossil fuels, not all skills can be repurposed. Some of them can be. If you work in temperature engineering, you can work in renewables. If you work in drilling, it's going to be very difficult. But then it's kind of thinking about which parts of the short-term objectives can be repurposed, which ones are gone. And the case of Nauru, which I've often used, is a cautionary tale in that regard, because short-term extraction of phosphate meant that long-term renewable income of agriculture was destroyed forever, right? And this was a context in which the short-term plan just meant that in the long-term the country was going bankrupt. And now its main source of income is being a refugee detention center for Australia. So this is the opposite way, but I guess these are the questions in terms of short-term planning to keep the future windows open as opposed to closing them down.
Thank you. Thank you very much. It's lunchtime. Thank you all for your questions, and please join me to thank the excellent speakers.
I am Zuzana Fungacho. I'm a senior advisor at BOFIT, and I will be chairing this panel. So in the morning, the discussions concerning the debt were focused on sovereign debt and how we will turn, and now we will turn to the corporate debt in emerging markets. And we are very happy to have 4 distinguished speakers with us today. So we have Professor Emeritus Seppo Honkapohja from Aalto University here. Then we have Sanjay Banerji, who is a professor of finance in Nottingham University. Then Adam Gulan, who is senior advisor here at the Bank of Finland at the research unit. And Eeva Kerola, senior economist at BOFIT here in Bank of Finland. So similar to the previous panel, each panelist will have time for his talk. Here we will have 7 minutes for each panelist. And let us start with Seppo. So I would like to ask you, how do you see the global economic situation in terms of risk to the financial system now? So Seppo, please.
Okay, it's a pleasure to be here. And I have limited amount of time, so no further comments on general comments. So in response to what Zuzana was asking, I'm going to talk about the financial situation from a general perspective first, and then something about the corporate side towards the end, and emerging markets as well. So as you all know, I'm sure, the situation is in the world is significantly worsening. This has happened now right as soon as the COVID pandemic was being brought up under control, and so we had the COVID crisis, which was a significant crisis, and now right after that we're getting a downturn in the economies. And interestingly, what is interesting is that these negative trends, current negative trends, they stem from supply side concerns from the COVID. And so this is, this is an example of a significant supply side shocks, which we don't see negative shocks in supply in the economy that much. And so that's the situation. And of course, as you well know, the two main concerns are inflation and related to that, the significant tightening of monetary policy. Let me start with the risks to financial stability. And let me just see that. Hang on. Or maybe it's not on. Let's see.
No.
Yeah. No, it's not on. Yeah, there we are. Okay, so I'm going to use three figures, but they are figures, not 3 slides. They are figures, not text. So I'm allowed to go above the limit. So anyway, the first is financial risks. You can see here the financial conditions index for main areas there, and also a shorter term figure about what's the situation in the markets, the volatility and liquidity, which show these trends. And indeed, the risks to financial stability we see in increased volatility in both equity and bond markets, and of course the near-term forecasts are showing for a slowdown in growth and still fairly high inflation rates, possibly slowing down a little bit next year, but then that's of course a very uncertain situation. So the risks to near-term economic development are also like policy rates, as you know, are increasing quite rapidly and are expected to increase further as we go into 2023. We're also starting to have in Europe these problems with some of the euro area countries, some southern European countries. We are seeing increases in bond yields, which are now at the pre-pandemic level or even slightly higher. And of course, if you look at the emerging markets, there are differences, but on the whole, the stock markets in emerging economies have developed negatively. Of course, it's not universally true because there are these commodity producers economies, and their stock markets, of course, have been improving. And you can see these phenomena with those two slides here. So if I now turn into the what about the emerging market economies? Some short summary. Again, there's the financial conditions for the emerging markets, and as you can see, there are on the whole negative developments for these EMEs. The commodity prices is as I said, that's a non-universal situation because there are commodity price producers. But the prices, those markets have been fairly volatile: oil, wheat, and natural gas, for example. Similarly, metals is showing a similar development. An increases in early this year, and then volatility in the prices. And EMUs have then faced this tight situation, and so central banks also in EMUs, not only in advanced economies, are on the whole in the process of tightening their interest rates. Stock and bond prices have fallen in the US and European markets and also emerging markets, except for these commodity exporters. The US dollar increase in the US dollar exchange rate is of course one other major development here, and that has gone up against most currencies in advanced economies and EMEs as well. Borrowing costs in low-rated markets have increased a lot, and are higher than those in investment grade. And then portfolio flows have also been under pressure with increased currency outflows that have stabilized. It should be said for some, but not all emerging market countries. And you can see some of these figures here in these, not really the currencies, but the financial conditions. And also we see that if you look at the banking system. So here we have on the right-hand side, we have the advanced economies, the percent of assets below 4.5% common equity, tier 1, and we can see that there is no problem in the advanced economies, but there begins to be a problem for emerging economies. Quite clearly, about nearly a third of these bank assets are below the common equity tier 1 ratio. So the interesting thing about these problems is that, one can argue, what sort of shocks did we have? Of course, the COVID shock was significant, and it created these bottlenecks, lockdowns, etc. And they are significant shocks, but they are not. Are they global shocks? Why are they not? Why are they? The consequences we are seeing are largely global and not just regional. It's not an entirely clear picture. Obviously, the second thing which we see in Europe, but which has international repercussions, is the Ukraine war, which started in February. Again, it's not a global event, but it has had a significant international repercussions because of the energy markets. Energy markets, the supply of energies and also demand for energies has changed as part of the conflict in Ukraine. Of course, we are also in an interesting situation in the sense that we don't quite know. We are in the process of this happening, and it's very difficult to say what's going to happen. And second, I should say, there are also time lags. Luckily, the financial data and price data comes quickly, but what about the real economic activity? We are seeing the first quarter of this year, the second quarter, tentative numbers, but that was most. And so that's also says that we are in the middle of this process. Hard to say anything very definite where this process is going on. And I'm also almost out of time, but let me show you the third figure, which is about the sovereign debt exposures of banks in emerging markets in comparison to advanced countries. So on the left you see those situation that especially in emerging markets we have banks which have a lot of sovereign debt in their portfolio. And then on the right we see a little bit of the structure of these debts, and we see that yes, there are this is in about the bond holdings in various places, and you can see that there is again the same picture, same result. There's domestically held debt a lot, and in particular banks are important as part of this. So what we are seeing here in these figures is that after the COVID pandemic there has been a tighter situation with the sovereign bank nexus in the emerging markets in particular. Sovereign debt holdings are now about 17% of assets, and that's the left-hand figure. And in the advanced economies they are something like 7 to 8%. So there's a very significant difference there. At the same time, of course, public debts are in many countries high levels, and sovereign debt or credit outlooks are deteriorating. So this is I'm not saying that this is uncertainty, but this is saying that it is possible that in emerging markets or in some of them we are going to start to see this problem of a feedback loop between the banking and the sovereign. So, and we know that if that gets bad, then that's going to be a big problem in macro financial stability, and that could spill over to the funding of non-financial firms as well. If we have a serious financial crisis of that sort, then that's going to be financing difficulties for non-financial firms. And the problem again is the same as what I said already before. This process is going on at the moment. We don't have any certainty or it's even hard to give probability statements about what might happen. But it's worth keeping in mind that this problem exists and could get worse.
Okay, thank you very much, Seppo. And now let me pose a question to Adam. So, what do you think are the important features of the debt of non-financial companies in emerging markets. Can we see some similarities between these countries?
Yes, thank you. So I wanted to mention two features that characterize non-financial corporate debt in emerging countries. And one is related to its structure, and the second is related to issuance of that debt. So if you look at the first slide, this is the decomposition of non-financial corporate debt in selected emerging countries, divided into two main categories: bank loans on the right and the bonds on the left. So the measure here is outstanding stock of that debt relative to GDP expressed in percent. So if you look just briefly at the y-axis, you see that loans are still the predominant mode of finance relative to market debt. It's still much bigger. But the trends are different, right? So if you look at loans over the last 2 decades or a bit less, you see that this bank loan lending has been relatively flat in most countries. You can see some trends in Russia, which is green, and China, yellow. But apart from that, it's pretty flat. You see the global financial crisis. You see COVID here, but these are stock variables. So, these are just optics or slight wiggles in the data rather than trend breakdowns. So those trends seem to be stable. Now, if you look at bonds, however, those trends are very different. You see that most of those countries plotted here have seen a sharp rise in issuance of market debt. And in some cases, like, again, yellow China, Mexico is brown, and orange is Thailand, have seen essentially an explosion of market debt. I have reported here most of major emerging countries, notably skipping India, Turkey, and any of the Central European countries such as Poland. They also see the trends, but the bond markets are relatively minor, so they wouldn't even fit the scale. But Sanjay will have more to say about this. Now, what drives those trends? Well, you can think of push and pull factors in international finance, right? And the pull factors will have to do with the fact that we didn't have seen many emerging market crises like the ones we have seen in the 80s and in the 90s. So those countries have grown bigger, richer, more stable economically. They became a larger share of global economy, so became more attractive investment places. So firms in those countries have accumulated more equity, and clearly they became more attractive. Now, for the push factors, well, the main elephant in the room is perhaps the very expansionary monetary policy that the developed world has witnessed over the last decade. Now, the trends, as you see, they have been before 2008, but they have really picked up after the global financial crisis. And with international investors having hard time to find high return assets in the US or in Europe, they would essentially search for yield and turn more to emerging economies. For banks, it's more difficult because banks after the GFC have witnessed tightening of regulations, and you can say that they became more risk averse in terms of purchasing assets from abroad. So hence this rebalancing to bonds. And overall, the supply of for investment funds or pension funds in developed world due to aging population has been growing. So the necessity to invest those funds goes up. Now, the second thing I want to mention more briefly is the is more about data reporting. So most of the data that you will ever see, including the graph that I have shown before, is residence-based debt. If the firm is registered in the country, within the country border, then its debt will be on the debts of that country's debt statistics. But it frequently happens so that firms have their daughter companies offshore, and it is those daughter or even granddaughter companies that issue that debt, and in which case the debt will actually be reported in the offshore country. So take a clear example of China, which would have, due to capital controls, a daughter company in Hong Kong, and that daughter company in Hong Kong will issue this debt. So in the drastic case, if you look at the right panel, which is emerging countries, and you look at the black dots and the very right y-axis, this is percent. This is percent of all international debt of NFC firms for a given country. And the 90% for China, which is the left column, tells you that 90% of Chinese international debt is not issued in China itself, but offshore. And it can be Caribbean offshore centers, it can be East Asian centers. So, in other words, the international NFC debt is 10 times bigger than what the residence-based statistics tell you. And so this is an issue because it matters for interpreting the numbers. It matters for knowing how much debt do we really have. That debt which is issued offshore is essentially 100% dollarized or euroized in some cases. And there is also a lot of off-balance sheet items like foreign exchange rate swaps, etc. That so this is a challenge for monitoring, and this means that we don't have a very good picture how big that debt actually is and how it will behave in times of stress. Thanks.
Thank you very much, Adam. You are perfectly on time. Very nice. And now we will move to two big emerging markets, and we will look at the situation there. So Adam has already mentioned India, and that it was somewhere else, not on that graph. So let's ask Sanjay, how has the corporate bond market developed in India? And yes.
Thank you, Susanna. Okay, and thanks. First, I really kind of thank the organizers for such a brilliant workshop conference, because I also, since morning, have learned a lot of new things. Okay. Now, I will be mostly talking about the Indian experiences, but I have decided to go a little bit a different route because I have seen most of the speakers were concentrating on the debt market, right? So, I will be talking about the debt market experience in India first, and then I will talk about, since innovative finance is kind of one of the topics, I will be kind of coming towards the later part of this talk on some experience in India, the innovative finance part. So, corporate bond market Indian experiences actually had been quite piecemeal. Okay, there have been some periods the government and the investors have tried, had succeeded, again failed, succeeded, failed. Okay, so compared to what Adam kind of showed, the corporate debt markets in the other countries. So the Indian scenario, okay, was kind of a pretty dismal, I would say. That is, though it is increased by fourfold, okay, from last 10 years, say from 10.62 billion outstanding debt to 48.24. But compared to, say, the trillion levels like in the US, 17.6, even Korea is 2.2 trillion, China is 26.7, okay, the market is kind of pretty much not in very good in shape. And also the corporate debt to GDP ratio. I mean, what the matter is that compared to the GDP of the country, how big your market is, right? So we have to kind of absolute number doesn't matter much. So the tail of woes could be traced to, say like India could suggest like 22% compared to 85% US and 101% on average recently. So there are multiple hurdles, okay? We had kind of some time back mentioned those, okay, and I'll be just referring to this on the passing. For example, in order to have a bond market, you have to have proper infrastructure, right? The infrastructure means like, this is the intermediation. So like the bond dealers must be holding the inventory of bonds in order to make the market for buying and selling and etc. So there's a lack of intermediaries, lack of secondary markets, right? One buys bond in case of a liquidity shock, they want to get out, but then you don't find a counterparty to sell or buy, right? So all these things. Now, yet the government has made, for the last couple of years, one very big changes, okay? Because in the bond, we kind of get like the fixed coupon unless there is a bankruptcy. So what the investors tend to worry about, how much I get if the companies go wrong, right? So in the bankruptcy, kind of India was, say, almost like, for a typical time for resolution of bankruptcy was almost, say, 8 to 12 years. But very recently, there had been a kind of a insolvency and bankruptcy code, and that exactly tried to resolve that issue. And of course, the recovery rate has improved from 4.1% to 45%. Okay, the time for the resolution that has kind of gone down under bankruptcy, okay, to nearly 2 to 3 years, even sometimes less. But the haircuts have been massive. Okay. Which means that although the number of recoveries have increased, okay, but each case, the slashing of the price in bankruptcy, that has been extremely dismal, sometimes 90% of the cases. So I'll be kind of stopping for the Indian experience on the corporate bond market over here, okay, because lots of efforts have been made, but we didn't make much of a move, okay. But on the other hand, see, financial architecture, even today's mornings talk about the green finance and etc. We're talking most of the times only the bond market. But the financial market actually kind of has a huge architecture. Like bond is kind of one part of it. I mean, there are equity markets, there are different equity related product, bond equity related products and etc. So I would kind of just mention like there's some success in the equity market, especially for the small and medium sectors, okay? So in India, basically, there are many other countries as well, but where the success of India kind of came in is that, so there are SME platforms, there's two big SME platforms. So there the less restrictions of kind of, making an IPO over there. And so that many small and medium companies could kind of pursue it. And one of the interesting features is that there you can get upgraded to the main sector from the SMEs, which means that is the firms first initially starting with the SME sector platform, but if they grow in size, okay, make inroads into their sales and growth, okay, they can migrate into the upper, like, the topmost tier, right? So there actually what we have seen, okay, is that there's quite a bit of success, okay, like, so we kind of just had a study whereby we kind of compared the companies which are joining the main board from outside versus the companies which first initiated in the SME and then kind of got upgraded to, you can think about the football league, you can join the first division or somebody join the second division, become champion and go to the first division. So that kind of a thing. So there you could see that is there, like, again, for the shortage of time, I'll just say that is the firms which has kind of migrated from to the main board from the SME board, okay, they have done better performance in their equity, in the sense of higher expected returns, as well as their lower volatility. So what I'm just trying to say here, okay, especially I'll kind of just tie it up with this, in fact, this morning's context as well, okay, that think about a very broad kind of a financing where, say, think about green finance, where ultimately the problem is that adaptation to the new technology, right? So it's a kind of a technological progress. Now the technological progress actually, if you look at the technological firm, okay, none of them had the bank finances to begin with. In fact, actually, the earlier speaker was talking about the difficulties of the bank finances. Bank will always kind of look at the resellability, redeployability of the assets, okay. Now, somebody is doing changes in the technology, will have no assets if they fail, right? So for them, the bond market actually would be also called lukewarm as well. But at the same time, in order to supplement the bond market, what my main point here is that one should have different kinds of equity market, not for the top tier firms, but for a range of firms, very different kinds of products. For example, debt sustainability issue that in the morning I was talking about, the firms could, for example, swap from old debt to kind of a new debt, but they could swap from old debt to kind of an equity as well, right? So which means that it would be giving investors kind of a more choice, okay? It would be kind of giving the firms more choice. So the most innovative finance would be kind of integrating both equity and the debt market together rather than thinking in the silos. Am I right on time or?
Yeah, you are already over time.
Oh, I'm sorry. Sorry. Okay.
Okay.
All right. Yeah, I'm done.
Thank you very much, Sanjay.
I hope that I didn't take too much of time, right?
No, it's okay. But I started to look at you, that's why.
Okay. No, I know.
Okay, but now we still have time to move to China. And Eeva, we have already heard about the high levels of debt in China. So Eeva will tell us how have we come to this and if there is a way out, possibly.
Yes, thank you. And thank you for the organizers for inviting me to this panel. It's been a really interesting morning listening to the previous talks. So let's start with a figure of, we have seen like some of these figures already, especially with Adam, but here's a figure of non-financial corporate debt per GDP in China, and then in 4 other countries, Japan, Spain, and Thailand, to give some comparison of countries that have also experienced high levels of corporate debt in the past. So China has accumulated a massive amount of corporate debt during the past 15 years, and today it's equivalent, as Sanjay was showing the number, $27 trillion US, so it's equivalent to around 30% of the total global non-financial corporate debt. And the accumulation actually started in earnest after the great financial crisis in 2008 and 9, when China stimulated the economy by massively encouraging different agents to take on more debt and then invest that money into infrastructure and other construction projects. And according to the initial plan, the funds needed for the stimulus would come from 3 different sources, so central government, local governments, and then banks. But local governments were already back then quite fiscally constrained, and because they were prohibited to directly borrowing either from banks or back then they couldn't issue their own bonds. So what they then did was they established these own financing corporations, or the abbreviation is LGFVs, or local government financing vehicles. So then took care of the borrowing and the investing. And the stimulus worked well, as we know, and because of that, I guess, this has been the way that China has boosted its economic growth ever since. Today, the LGFVs make up around 30% of the corporate debt in China. So one peculiarity in the Chinese context, with regards to the non-financial corporation debt is, in fact, that large chunk of it is at least implicitly guaranteed by the local governments. Now, today, it's estimated that almost 60% of Chinese corporates are today highly leveraged or highly indebted. The highly indebted here, by definition, is that their cash flows are less than 12% of their total debt. And half of those corporates that are highly indebted are in property and construction sector. And so as we can see from the figure, debt levels this high as we see in China today are, at least in the past and in different countries, have resulted in some kind of economic slowdown and deleveraging process. Now, officials in China are, of course, aware of this fact, and they know that high levels of debt is a challenge. And from time to time, they actually try to do things about it and try to bring it down. But for a country that has accustomed to boost its growth by taking on more and more debt and investing it in less and less productive investments, escaping this corporate debt trap is really difficult. And especially problematic it is in China, that has been stuck to these very high and very tight GDP growth targets for like over 10 years now. And one crucial reason also for the ever-growing debt in the corporate sector with these LGFVs is that the local government officials, their careers are really dependent on these unrealistically high GDP growth targets. So they have actually, if GDP growth is stagnating, they have no other choice but to take on more debt and invest in infrastructure or construction. So what China should do is to move away from these numerical targets and allow growth also to slow down from time to time. So for China to lower indebtedness would mean that they should tolerate also declining growth rates. And this is actually now what we are seeing is happening in the real estate sector. So the real estate sector has been highly indebted for years already. House prices have increased massively, and they have gone somewhat already out of reach of like normal workers. So it has also posed a social issue in the country. And people were no longer buying houses to live in. They actually bought them just to keep them empty for investment's sake. Because they thought that, or they think that house prices will grow up forever. So now about 2 years ago, China really decided that it was high time to do something about it, and they started to pose restrictions on the debt. So in the figure here, I have some indicators of the real estate sector in China. So you can see floor space starts, then there are sales of property and real estate investments. And the two gray bars, vertical bars, are then the most important policy decisions that were taken to curb this excessive debt. So the first one was in August 2020. Officials imposed these 3 red lines for the developers to tell them what was the maximum amount of debt they could take. And then the second one came some months later. That was restrictions for banks. So there were some maximum limits how much banks' balance sheets could tolerate real estate dependent credit. And then as a result, when the highly indebted developers could not get any more money from banks, they were left with their sales income. And at the same time, of course, 2020 was the COVID year, so there were some COVID restrictions, and actually the demand for houses was declining, so the developers were left with next to nothing. So they couldn't pay their subcontractors, they couldn't pay their loans, they missed their bond payments, they had to halt some of their construction projects. And as developers started to really be in trouble and it started to be visible, then people grew more and more uncertain about the thing, and the demand fell even further. So as you see in the figure now, we are the slump has lasted for around 18 months already, and there have been some estimates that demand could fall for yet another 6 months or so. And so it has already had a quite big impact on growth rates, but presently officials have held on to the initial goal of lowering the excess indebtedness, so they haven't stepped in massively to stop this decrease. So overall, as a concluding note, if China really wants to reduce its corporate debt levels, it would need to fundamentally change the economic growth model. So move away from the heavy investment and credit-driven growth and towards more consumption-driven economic growth, where perhaps the growth rates would not be as high, but growth would be more sustainable.
Okay.
Thank you.
Thank you very much, Eeva. So we are a little bit over time, I have to say. So let's see if there are questions from the floor. Anybody? Yes, let's start with Ugo. Microphone.
I have a question for Eeva. So I've done some work on Chinese debt, and one on especially the local. Yes, I always have problem writing that. But I don't want to talk about this. Another paper that we look at was on with Richard Portes and Yi Wang, was on the sort of possible negative consequences of regulations. And what we found that when the Chinese central bank tried to limit borrowing from what they define risky sectors, then we had other firms acting like banks. So we had very large firms which were not linked by this that would issue bonds in dollars in Hong Kong and then relent to the firms which could not access the credit market. So I don't know if that's something that you have been thinking about, because that's sort of, it seems that this regulation actually backfired and made the system even more fragile in a sense.
Yeah, thank you. That's definitely true. And in China, they are really innovative in how to get money if something is regulated. So there has been this really huge increase of the shadow banking market during the 2010s, like from 2012 onwards. But then they curbed the shadow banking market, and then it moved forward to something else like you just described. So yes, that is a problem. And one part of the problem is that we don't know where it is and where it comes from, and it can't be tracked. So yeah, fully agree.
We have 2 more questions, at least here in the front. Microphone, please.
Thank you. My comment is really about linking what we discussed now with the morning sessions. Because in the morning we talked about green transition from a capital allocation point of view and also from a policy point of view. This session is really about deteriorating financial conditions. So I wanted to hear from the panel if they see channels directing from financial conditions to green transition challenges. For example, if a bond becomes more expensive, a local business group in a developing country might cancel cleaner technology applications. If working capital becomes more expensive, the same for cleaning applications. So I wanted to hear more about this, and also related to the policy issue, if they can see any segment of industrial policy that can tackle these problems and these market failures as they evolve. Thank you.
Shall we take the second question as well? In the back? Yes?
Thank you so much. Great presentation. A specific point for Eeva. I think it's important to, when you talk about the Chinese targets for growth, the origin actually was related to figures on unemployment. I believe that the figure of like some 5 to 8%, whatever was calculated because it was believed to be needed to address the unemployment that was growing for the restructuring of the SOE. So it actually, that doesn't change at all your analysis, but it's like, you know, it was actually a great target to have because they were worried about social unrest, and it wasn't a particular financial, but you're probably still right, it probably still needs to be addressed. The question I have is also to you, because, but for the panel in general, maybe relates to the previous question. If I look at your first slide, I hope this was your first slide, I can't quite read it. The credit to non-financial corporates percent of GDP, that increase of China. I'd be interested to hear a little bit what those, thank you, what those comparisons mean. I was saying to my neighbor, when you're telling the story about China, that sounded a little bit like the history of Donald Trump's business. It's like, the question is how long people do get away with the debt they accumulate. The trust in governments, I think, is really important. What people explain to me is that why China has been able to have such an active private sector was that they have a trust in the government fulfilling their commitments. And I'm just wondering what the implications of that are. And there, on that graph specifically, is like there anything in there why it is become higher in China? And is it actually a problem if those government commitments are still to people still believe they are upheld? Thank you.
Thank you. So let's start. Whoever wants to answer.
Well,
maybe Seppo can start.
Let me take the green one. I'm not an expert on this, and I should really look at the sector more closely. But surely, if the financial situation is overall deteriorating, that's going to have an impact on that segment as well. That green financing and this project financing is going to be more difficult. How much more and so forth, I have no idea. But I think that this risk is and this tendency is likely to be there now in the right now. I should also add, which maybe a little bit to what I said, is that I've looked at various other information concerning how is the situation viewed, and the slowdown is fairly clear. But as I said, certainly central banks and other forecasters are suggesting that this inflation is slowing down now, has started to slow down, and they expect a significantly better situation next year. And that, of course, if that happens, that's going to mean that the central bank's tightening of monetary policy will also be less than what was perhaps perceived a little while ago. So that's certainly one important thing here as well. There's also the question of the real growth of the economy, which I didn't have time to talk. But there again, there's slowdown, but still the main forecasts of various institutes are in the positive side. But I have seen also some risk scenarios which even suggest negative growth slightly. So that's the situation concerning the other forecasting institutes. So I think it's telling us that we have difficult times ahead, but how difficult it is indeed very difficult to say right now.
Okay. Yes, Sanjay?
Okay. I would kind of add something related to what he's talking about, that is, the world has probably kind of gone too much with the debt financing. But we already kind of know that there's a debt overhang problem, the risk shifting problem in the sense people take lots of riskier projects with debt financing and etc. Now, two issues. One is a post-pandemic situation. Obviously, like in similar circumstances, equity would be better than debt because the production instruments are already there. It is because of the problems of the contactability and disease. That's why you cannot pay the banks or the investors right on time, right? So that the government has to kind of come up with a massive level of subsidies, printing of money, and I'm sure there is some of the problems that we are facing about this inflation partly due to all those kind of a liquid monetary policy carried out from those days. But with the equity financing, of course, there are some negative aspects are there, I'm not denying. But given the situation that if a shock is struck, okay, by the forces for which no individual is responsible, right, then one should not, basic information theory says then you should not kind of ask the person to pay for it, okay, which is the interest is a kind of a commitment, but the dividend is not, right? And secondly, also today's in the morning talk about the sustainability and etc. So which means that if you want to do this debt restructuring, now obviously corporate debt restructuring, not just for the date's sake. For example, debt restructuring means what? You extend the maturity of debt. That's only one instrument. But you could, for example, convert debt with equity as well. So for that, you need some sort of a development of the equity market as well. Especially for the Indian context, I'm kind of suggesting is that for the small and the medium units, right? So because much of the technological things would be coming these days from the small and medium sectors, because we are not kind of going to see this huge GM or, these guys are coming. There are many app-based technology, many kind of a new technology are coming from the relatively, SME means that is the small levels of employment, right? So one should be kind of it should be a kind of until a complementary, platform to date is kind of developed, then it means all the shocks are absorbed by one particular sector. That's not good for the economy.
Let's continue with China.
Go ahead.
Take the Chinese question then.
You take the Chinese
Okay.
questions. Yeah.
So yeah, definitely there is high trust in government that it will step in if needed. And these implicit guarantees have been one problem in in China because the risk is not visible, or you don't you think that there is no risk in buying bonds of corporates that are somewhat related to government. And actually they are now trying to do also something about the implicit guarantees, especially with the LGFVs. So Beijing has started to say that if an LGFV goes insolvent, it should go in bankrupt and local government shouldn't step in. So they try to actually break this implicit guarantee now for the LGFVs. Let's see what happens. I don't know, if one big LGFV goes bust, and I don't know what would be the implications for the whole market. Yeah, so that's one reason why China has been able to sustain these debt levels it has, and also one institutional, I don't know if you could say it's a flaw, but a need to save excessively. So the savings rate in China is like 48% or 45% or something like that, because they don't have safety nets and they have to save for their old days. And that's one reason why the debt levels are so high in China, because there is so much excess saving. So that's, on the other hand, it's a good thing that it's domestic-backed debt, but on the other hand, it's like the money would be more efficiently spent elsewhere, I would say.
Thank you. We have a question here, Tony.
Thank you. My question relates to the growth of the ESG mandate in the investment industry, so the environment, social impact, and corporate governance mandates, which have now, risen up quite considerably in the marketing of funds. And there are, very mixed opinions about whether ESG is actually a valuable contribution or not. But I wondered what implications this has for getting more capital, either equity or debt investment in the developing world, because, of course, there are now emerging market funds with ESG criteria, which are relatively sort of small scale on the global financial landscape, but you would think there are potential opportunities, particularly picking up on the themes this morning about companies that have a very good innovation technology in environment, climate, a small SME that's doing excellent work in that area. Is it investable in terms of debt or equity? Could it attract the ESG emerging market funds, or is this something that's for the far future? Thank you. So that's a question for anybody on the panel.
Yes, and let's take Kunal as well.
This is a very different question. I mean, so far we've been talking about the debt crisis since the morning, but I was listening to presentations on the data. It seems there's also a financial crisis looming, not too far in the future. From the data they suggested, he presented the examples of massive haircuts in India, the China property boom. So is there a possibility, so the debt crisis, the sovereign debt crisis, but a financial crisis of where banks and non-financial corporations go under? Is that possible in the emerging market context, as we've seen in 2008, in the mid-90s in East Asia, the Latin American debt crisis, financial crisis? Yeah. What's the possibility of a financial crisis going along with the debt crisis, which would be the worst of all possible worlds?
Thank you. So who wants to start?
Maybe I...
Oh, why don't you do it? Why don't you do it?
Okay, so maybe I can say something about the financial crisis. Well, there is known unknowns and unknown unknowns. We already know from the experience of old times sort of how the emerging markets, some types of emerging markets crisis work, like the sovereign debt crisis in the 80s, or then the East Asian crisis. Now, we have already learned from that, so presumably some of those mistakes are partly avoidable to the extent that we know the data. So we, for example, know the problem of dollarization, right? Now, this has, for example, the problem of dollarization has changed. So back in the 80s and even in the 90s, a lot of emerging markets sovereign debt was fully dollarized. So those countries faced clear currency mismatches in the sense that a lot of debt was in dollars, but revenue is taxes, and taxes are local currency. So clearly an exchange rate movement creates a problem. Today, with this huge pile of corporate debt, the picture is more mixed. A lot of firms that issue debt, foreign debt or international debt, it is dollarized, but only some of those firms would have the currency mismatch. So commodity exporters, a typical thing in emerging and developing countries, they don't have this issue because it's oil and it's food, and this is all traded in dollars. But Eeva will have more to say about this. If you have debt, say, in the housing sector in China, which has all the revenue in yuan, I mean, as long as yuan stays on fixed exchange rate, it's okay, but there is a clear potential currency mismatch there. Now, another risk is a bit perhaps related to this offshore problem, is the lack of data and the overall development of finance, the fact that a lot of financial contracts are not even on balance sheets because they're foreign exchange rate swaps or different types of derivatives. So they are only conditional. A lot of derivatives are used for hedging, but not necessarily. And then we will presumably only know ex post because we don't have that data, how those risks will resolve.
Thank you. Seppo?
Well, Adam already said quite a lot of things. Especially this currency mismatch issue, which can be important for developing countries. I think otherwise, I think again, my feeling is that this time, first of all, the situation doesn't look that bad at the moment. The trends are worrying, but so far, it's serious, but it's not really a crisis yet. And then the question is, are we, which Adam already posted, have we learned from the past mistakes? And certainly, yeah, we have one thing we know, as he said, we have the corporate debt is one part of the story, which is bigger than before in the earlier crisis. But there are a lot of uncertainties. So I will not put any bets on any directions. And the second thing is the Chinese debt, which I must say, this continues to be a puzzling. I remember I think it was 8 years ago, I gave a talk about the international debt situation, and I showed a graph where the Chinese debt ratio was much higher than the historically other ones have been, and said that is suggesting trouble. Well, that's 8 years ago. There's maybe some trouble, but not really a crisis yet in China. So maybe the answer is that people trust the Chinese government still, or they have deep enough pockets to handle this situation and the will to handle this situation.
Other comments, Sanjay?
Okay, I'll kind of address this ESG and the governance issues, okay? See that like the ESG is an objective, not necessarily it would be a farm objective, right? It is a social objective. And in a typically kind of a, in a company with agency issues, with some small founding shareholders and lots of dispersed stakeholders, so one needs two things, not only a large shareholder that we already kind of know for the proper governance, but a large shareholder with an ESG objective. For example, pension funds, for example, okay. So until and unless, in equilibrium, in endogenously it would happen, only in the market there would be a sort of large investors who would have a high stake enough to exert their pressures in the governance, but then their objectives must be aligned with the social objectives than the firm's objectives. Until that sort of things happen, or even I really don't know how those things happen in equilibrium even, because different institutions' objectives are different. So the answer is that like we probably should not expect much to see the financial markets to make some progress towards ESG unless there is a matching of the objectives.
Okay, Eeva, do you have anything to add on China?
No, except echoing Seppo in that probably it is the deep pockets that's ultimately the thing that is refraining China from experiencing a financial crisis, because there is like these ownership and financial linkages are really opaque and complex, and one would think that there is like a high risk that something bad would come out of that, but it hasn't yet. So let's see.
Do we have any more questions? We have time for one short question, if there is any. I can ask about the future maybe. So what do you think are the costs and benefits of the rise of in non-bank financing? What do you see like going forward? Very short answers and clear. Any ideas?
I guess
Adam
I can take some of it. Well, so there is short run and long run. In the short run, it is more likely that I think that the growth in bond issuance may stop, and this may slow down. And the simple reason is that bonds are instruments that are more attractive in good times, and they also require the investors to have a fair amount of skin in the game. Now, as the economy is subsiding now globally, clearly, this becomes an issue. Now, bank financing is more attractive in bad times because, it's renegotiable debt. So from that point of view, I would say that short run is more in favor of bank loans. Now, in the long run, no. Bonds tend to be cheaper. They have been also, it's a more long-term type of instrument that is used by larger firms. As firms grow larger in emerging countries, more of them will be seen to issue bonds. Let me stop here.
Thank you. Any other predictions for the future? Yeah.
No,
Sanjay can go.
Go ahead, you're a finance professor.
No, you see, that is innovative finance. Let me kind of just, I think I'll just say, just look at, say, today's technology, this everything that we are in this room, right? It was kind of completely non-existent 15, 20 years back, right? So it has been kind of made possible through the venture capital organization of those intermediary within the financial sectors in a very big way, with making complex contracts with the investors. Okay, I mean, there are several studies, okay, documenting how the venture capital kind of works. Now, nobody actually asked them to produce internet, right? So that's how the market kind of responded. Like, with the new technology, number one thing, you're not going to get bank because bank always looks for the safe ventures, right? The equity market, okay, they would be kind of just too risky to be listed. So you need somebody kind of, helping them to grow. So similar to, I say, an intermediary, not exactly as a replica of the venture capital before, but something with this ESG objectives and finding it out. So that probably over time, it may happen, may not happen. But looking at because we're still today's whatever I've just learned, okay, a little bit from today's discussion, that still all this ESG is still confined with the traditional modes of finance, right? Green bond is after all, at the end of the day is a bond, right? So whether it's called a blue bond and etc., just kind of say one particular thing in this context, okay? Say, for example, if a green bond pays money, then people don't ask questions, okay, whether there's been invested in the green technology or blue technology or whatever it is. The investors are kind of quite happy. So which means that there is no rating agencies that will kind of give the ratings in both dimensions, the probability of bankruptcy and also the quality of the project, right? Unless those sort of instruments institutions do not appear in the market, probably I'll see that is the traditional finance, as you say, bank or this will kind of grow. And then if there is some need or some vacuum, then probably that will kind of come up.
Okay. Thank you. This is a good time to finish. So let me thank all the panelists for their contribution and everybody for the attention.
So, good afternoon, everybody. I'm happy to chair the next session. My name is Emmi Oikari. I come from the Ministry for Foreign Affairs, where I'm leading the unit for development finance and private sector cooperation. And the topic of our session is the World Development Report 2022. Finance for an Equitable Recovery. First, we will hear about it and then discuss about it. And the report looks at the role of finance in the economic recovery from the pandemic. And obviously, the report highlights the challenges as well as the consequences of the crisis. It should be noted that the report was published before the Russian invasion of Ukraine, which some of you already mentioned this morning, as of course only making the situation even worse, especially in terms of energy and food security. When I was reviewing the report, what really stood out was the call for transparency. Something we also have discussed already during this morning. But let me now introduce Leora Clapper, who will present the report together with some of your colleagues, I was just told. Leora is the lead economist in the Finance and Private Sector Research Group at the World Bank. Her publications focus on corporate and household finance, entrepreneurship, and risk management. And I was also very interested to learn that her current research studies the impact of digital financial services, especially for women. But now, Leora, please, the digital floor is yours. Welcome.
Thank you. Thank you for the invitation to join you today to discuss our 2022 World Development Report, which we launched last spring, Finance for an Equitable Recovery. Which unfortunately has become our recommendations have become even more urgent in the current environment. This report was drafted by an interdisciplinary team from both the World Bank and the IFC. I'm joined
this morning with a colleague from IFC, and we hope that our report will elevate these issues among government priorities during the recovery. And so, like your conference, the report touches on encouraging sustainable private and sovereign debt and the importance of green finance. To summarize, our report focuses on the unprecedented financial and economic risks that were created or worsened by the pandemic and the pandemic responses, and more recent macroeconomic threats caused by rising fuel and food prices, and the war in Ukraine, growing climate risks, which have all hindered a swift recovery from the pandemic, and outlines concrete steps that policymakers can take to address them. So the global public health crisis that was triggered by the pandemic quickly led to an economic crisis, which increased global poverty and inequality and dealt the biggest setback to global poverty in decades. In 2020, economic activity contracted in 90% of countries, and global poverty increased for the first time in a generation. And so while the wealthiest 40% of the global population continues today to recover, we're still seeing the income of the poorest adults continuing to decline and expected to decline further. For example, the World Bank's 2022 Poverty and Shared Prosperity report shows that global progress in reducing extreme poverty has effectively come to a complete halt. And so even as countries around the world were struggling to contain the spread of COVID-19 and managing the health costs of the pandemic, governments were quickly implementing an encompassing and really unprecedented response of fiscal, monetary, and financial sector policies, all aimed at limiting the worst immediate economics of the health crisis on households and businesses. A theme we really pull out in the report is the impact of macroeconomic policy on households and firms, these micro effects of macro policies. And so we collected data showing that these included direct cash transfers, debt repayment moratorias, as well as central banks' unconventional monetary policies that we're seeing today the ramifications of, such as asset purchase programs that were effective in pumping liquidity into the financial sector and were used by 27 emerging markets for the very first time during the pandemic. So, for example, early in the crisis, the Philippines took 22 measures to support the banking sector, 11 to improve liquidity and funding, and 6 to support the payment system. And so in the midst of the crisis, these policy measures provided much needed liquidity support to households and helped avert a wave of loan defaults that could have threatened the stability of the financial sector. However, policymakers around the world needed to achieve a balance, and now we're trying to achieve that balance between providing enough support to prevent the worst human costs of really the growing economic and political instabilities, while limiting longer-term risks, such as growing sovereign debt, rising inflation, and expanding non-performing loans in distressed firms. So our conceptual framework illustrates a central message of the report, that the numerous mutually reinforcing channels that connect the financial health of households, firms, financial institutions, and governments can trigger a global financial chain reaction. And this means that elevated financial risks in one sector can spill over and destabilize the entire economy. And again, we wrote this in the context of the pandemic and the recovery, although unfortunately, there's really tremendous urgency to these risks given rising fuel and food prices and the ongoing war in Ukraine. So to give some simple examples, inclusive access to finance, to financial services offers households and businesses financial resilience to economic shocks and unanticipated expenses that many in the world are today experiencing, and allow firms to invest in the recovery. But banks confronting decline in loan quality tend to tighten their lending. And these reductions typically hit lower income households and small businesses the hardest, setting up a negative feedback loop between financial sector performance and real economic activity, with the potential to increase income inequality. And so official statistics seem to show that non-performing loans in some markets are growing, and there's reason to be worried. For example, even before the COVID-19 pandemic, global household debt had increased by more than 30% as a share of GDP since 2008. And household balance sheet data showed that in low and middle income countries, only half of all households had the liquidity to sustain basic consumption beyond 3 months. And business performance also seems to have been affected. I've been looking at data from using with the MasterCard Economic Institute that suggests that globally, business failure rates have doubled in 2020 and 2021, above the 2019 and 2018 baselines. Loan defaults can now sharply increase, and private debts can quickly become public debt as governments are forced into bailouts. Households and firms suffering from lower income and revenue also pay less in taxes. In addition, when the financial position of the public sector deteriorates from both higher debt and debt servicing, this may weaken the government's ability to support households and firms in need. And we also discussed global risks, such as the rising interest rates and inflation risks, which were a little more hypothetical when we wrote the report, but are not today, which, as Augustine Carson's explained nicely in a 2020 speech on central banks and inequality, inflation is a regressive tax that disproportionately hits the most disadvantaged because the poor sees their wages erode, but typically don't have inflation-resilient assets to hedge their risks. And therefore, the responsibility of central banks' macro stabilization role can help make a more equitable society. So the policy challenges going forward will be to ensure sustainable debt burdens and uninterrupted access to formal credit, so that first, households and businesses, especially low-income households and small businesses, maintain access to financial services that offer financial resilience to economic shocks and unanticipated expenses, and allow firms to invest in their recovery. And second, governments and financial institutions can support the recovery and provide adequate financing, including for investments in all the services that governments need to support, such as education and health. And so our report focuses on 4 priority areas and policy measures that government should take now to avoid major financial upheaval. First, increasing transparency and reducing the share of non-performing loans to ensure banks can continue to lend. Second, to ensure effective procedures to discard distressed debt, including out-of-court mediation and conciliation, which World Bank experiences have shown can be especially beneficial to small businesses and individuals. Third, to ensure continued access to credit. And fourth, to manage sovereign debt sustainably. So let me run through the first 2, and then I'll pass on to my colleagues to talk in a little more depth. So the first area for policy action that we discussed in the report is a need to address risk to financial stability, to ensure that banks can continue to lend to support the recovery. So one of the main recommendations of the report is that problem assets must be recognized and dealt with promptly. The faster that non-performing loans are addressed, the sooner banks and microfinance lenders will be able to support the recovery. And we bring the evidence why timely management of non-performing loans is so important, really highlighting 3 reasons. First, that high non-performing loan levels burden all levels of an economy. We discussed in the report research showing that delayed action can cut off access to credit, destroy jobs, and discourage entrepreneurship. Second, how high non-performing loans depress economic growth, as for example in the well-documented case of Japan's lost decade of growth. And third, that without swift policy responses to hidden loan distress, we could also see an increase in evergreening. This is a continuous rolling over of zombie loans to businesses that are weak with little or no chance of returning to health, and politicized government interference in debt resolution. This ultimately translates into lower economic output, investment, and employment. But the negative cycle of high-performing loans leading to low economic growth is not inevitable. Establishing an effective NPL resolution strategy that involves regulatory authorities and the private sector working together is an urgent priority. And there are many benefits of early and decisive action. First, unambiguous regulations to identify non-performing loans allows lenders and regulators to assess the magnitude of the issue and take prompt action. As you mentioned earlier, transparency is a critical theme. Transparency on NPLs, on distressed firms. Second, building banks' operational capacity to deal with a significant increase in NPLs can improve the efficient resolution of distressed assets and free up resources for credit intermediation. And third, authorities should be prepared to quickly assist troubled banks while always prioritizing and exhausting private sector-led and funded solutions before resorting to bailouts. And so experience shows that taking action allows non-performing loans to be brought to sustainable levels. The objective should not be to pursue zero-level non-performing loans, but to have banks taking on a level of risk that doesn't compromise their financial soundness. And so in the report, we highlight some examples of countries that have successfully equipped their financial sector to address rising levels of non-performing loans. For example, Serbia established a national NPL working group to reduce stubbornly high levels of NPLs in the aftermath of the 2007-2009 global financial crisis that effectively recapitalized and strengthened their banking sector. The second risk we discuss is debt sustainability. And so a wave of loan defaults can destabilize financial institutions and create contingent liabilities for their governments. There's a risk of zombie firms and politicized government interference in debt resolution. Ineffective insolvency regimes can reduce access to credit, again, especially for riskier, smaller firms and households, by reducing creditors' confidence that both that they can enforce their rights in the case of default and collect in the case of default. Delayed actions can cut off access to credit, destroy jobs, discourage entrepreneurship. These governments should prioritize strengthening formal insolvency frameworks, including conciliation and mediation. It's not easy to pass through bankruptcy laws, especially during a crisis. However, a growing number of out-of-court procedures have been very effective, especially for SMEs. And history shows that insolvency reforms that encourage out-of-court debt workouts can be effective at bringing down non-performing loan rates. Efficient liquidation procedures can facilitate market exit of these zombie, non-viable firms. And that hybrid out-of-court arrangements that reduce the extent of court involvement in restructuring can ease the burden on overcrowded courts and reduce the costs, especially for smaller businesses. So we bring lessons learned from the MSME insolvency reform during the Asian financial crisis in the late 1990s, early 2000s. For example, in Indonesia, a judicial reform program enacted in the aftermath of the Asian financial crisis helped to reduce the time needed to conclude an SME insolvency from 72 months in 2004 to 13 months in 2012. We also discussed the comprehensive and ongoing insolvency reforms in India, starting in the 2016 overhaul of the business and personal insolvency framework, which more than doubled the recovery rate for creditors, although backlogs remain an issue. In response to the economic impact of COVID in April 2021, the government of India added a simplified framework for insolvency of small businesses, which might ease the demand and backlog for the corporate restructuring framework. And Colombia has introduced a temporary fast-track restructuring framework that's being administered by the Chamber of Commerce for MSMEs. So before passing the floor to my colleague, let me mention spotlights that are woven through the report, focusing on development finance, including the regulation of microfinance institutions and the role of contained and well-governed partial credit guarantees. But we also discuss the importance of strong financial markets to accelerate the transformation towards a sustainable world economy. Examples of how regulators can incentivize green investments, such as mandating higher risk provisioning for loans to sectors engaged in non-sustainable activities. We also discussed the role of capital markets, which was discussed earlier, and how the economic stress arising from the pandemic propelled the expansion of sovereign, sustainable green-blue bond issuances. Although there's no conclusive cross-country patterns, some sovereign green and social bond issuances have paved the way for similar debt issuances by the private sector. So some suggestive examples how government issuances could crowd in private bank issuances include Chile, who in 2019 became the first green sovereign bond issuer in Latin America, and soon after a large private Chilean bank issued a green bond to raise funds for renewable energy projects. So let me start, is Rita here? Okay, so let me actually pass the floor first to my colleague, Benny Sanito, an economist in the Economic Analysis Department of the IFC.
Great.
Benny.
Thank you, Leora, and good afternoon, everyone. So far, we've heard from Leora that the report highlights the need to address outstanding credit, resolve balance sheets, challenges that banks and borrowers are facing. Where we turn with the contribution that I'll share with you right now is on the impact of the crisis on the bank's abilities and the economy's abilities to generate new credit, and particularly for those segments like MSMEs or lower income segments that were harder to lend to begin with. So we highlight three main policy messages. The first, which brings in the first two bullet points here on the slide, relates to the need to create an enabling environment for responsible lending innovation. This can help mitigate the heightened risk and uncertainties in the short run, or as we are seeing, the short run is extending a little bit because of compounding elements around it. But also in the long term, it can help make markets more inclusive and resilient to future shocks. Some of these enablers include policies around greater data access by lenders, both in terms of new types of alternative data to help fill the gaps that traditional credit information is leaving, but also, especially important for emerging markets, to keep building on what we would consider traditional credit information systems and financial infrastructure, both in the forms of upgraded payment system, asset registries, and frameworks for allowing secure transactions that really can help improve the data quality on which financial.
Can you check? Can you check your connection? We can't hear you now. Still not. Yeah. Laura, we can't hear you either, but it seems that you can hear each other. Still no. That's like. How about now? Mm-hmm.
Previous panel, and their audio went away a couple of times.
Now we can hear you. Great.
Oh, fantastic.
Wonderful. Hi.
Should I keep going? Or,
yes, please do.
Okay. So a second enabler that we identify here is the need to update risk assessment and management tools for financial institutions. And this is, again, a survey of our financial institutions, I'll tell you a bit more about later, shows that this has been particularly infrequent among financial institutions in the post-crisis time, so in 2020 and 2021. A third enabler would be enabling innovations in products, as well as in the types of institutions that lend to MSMEs. And I know there was some discussions about MBFI lending in the previous session, but innovators such as data-driven digital lenders and embedded finance providers, while they can lead to some concerns and needs to update regulations, have the potential of bringing in different risk appetites and different potentials for reaching such underserved segments. Another recommendation that we bring forward in this work is the importance of balancing these innovations with appropriate regulation and infrastructure to counter some of the risks, and also particularly those related to financial literacy and cybersecurity. Furthermore, we can recognize in the draft. Sorry, Leora, just one still on the first slide. Recognize that the partial credit guarantees may need to continue. They were a central policy tool for through the crisis, and they may need to continue to be in place for a while longer to help balance the risk and returns for lenders. As economic conditions improve, however, we would expect that these guarantees are progressively narrowed in terms of eligibility to the sectors and customers that they serve, and they can possibly turn to and be leveraged to reduce some of the risk associated with longer-term investments. For example, some of the climate-related ones that were discussed in previous panels. So now we can move to the next slide. As we mentioned, the lockdown that emerged in 2020 in many economies and the shock to the economic activity that we saw over at least 2 years has heightened credit risk. What is somewhat unique from this crisis is that lenders saw their visibility on the borrower's capacity and willingness to repay loans particularly impaired during this time, and also saw more limited options for recourse in event of a default. And so these challenges as we have seen, have led to constraint in credit standards across many economies. And in the chart, we have an analysis across country that shows several quarters of consecutive tightening across markets in credit standards. And while the situation went improved in 2021, 2022 is showing again a shift towards tightening. What I present here is actually instead data from a survey of IFC client financial institutions, about 200 of them across emerging markets, that was conducted at the end of 2020 and at the end of 2021. And by 2021 end, we were seeing a very positive outlook on what the future and the future of the recovery would have looked like. And we were seeing already significant signs of recovery. At that point, 2/3 of respondents had returned to pre-crisis operation levels and expected to fully recover by 2020. Liquidity had held very well, thanks also to a strong performance of deposits, which were also a feature of many of our client financial microfinance institutions. There was a focus of IFC in the late 2000s, 2010s in terms of working with microfinance institutions to broaden their fundraising platforms. But collection levels, again, at the end of 2021, were still a challenge for over half of the lenders that we interviewed, and NPLs increased compared to pre-crisis levels, although not at the levels that we were expecting. We see, and you can see it here in the kind of last bar chart on this chart, we see that the impact on NPLs that we were seeing by the end of 2021 was almost exclusively focused on low and lower middle income countries' institutions. So inversely proportional to the amount of policy support that the economies and this financial sector had received through the crisis. So in this case, we see that there was an increase between 2019 and 2021 among the institutions in our sample, of course, of about 40% in the NPL rates, which is substantial. We can move to the next slide. As I mentioned earlier, credit tightening was a concern. Credit standards towards overall the private sector, but particularly the SME sectors, were tightening. We saw this across economies. What we see also from our client financial institutions is that 46% of them still maintain tighter credit standards compared to pre-crisis by the end of 2021. And again, as a reminder, by the end of 2021, most economies had rebounded significantly from a GDP perspective. It was certainly an expansionary period, which was then met with tightening conditions that occurred early in 2022. But in 2020, by the end of 2021, credit standards were tighter because the outlook for businesses was still deemed to be particularly risky, because the impact of the last 2 years on the economic situation of financial institutions was a challenge, and because of this visibility and recourse challenges that that I highlighted earlier. It was more difficult for lenders to assess credit risk, and the quality of collateral was a challenge. We can move to the next slide. What we do highlight in this chapter, in addition to kind of framing the risk and the challenges to lending, is what are some of the opportunities that are coming our way in terms of enabling financial institutions to be better at managing risk and avoid a credit crunch vis-a-vis primarily on one important digital dividend that was produced by the crisis, which is that business surveys and industry data show that markets witnessed a growth in the adoption of technology, both by businesses and consumers following the crisis. Much of it was forced by the lockdown. Much of it just gained priority as a result of the events during those times. So we see payments and technology adoption grow. This kind of allows us to highlight some of the strategies that lender can adopt to meet this heightened risk and uncertainty. But as many of you will notice, many of the ideas that we propose here are not new. We were talking about these way before the crisis as well. And so we highlight how these are becoming increasingly possible, particularly in emerging market context as a result of this crisis. So the first kind of big area that we focus on is that the digitization of activities and operations can allow lenders to leverage
Again, we lost you.
Leora,
it's fine.
Just so I'm sorry, I'm afraid it might not be my side that is challenged, but I wouldn't know how to fix it. Okay, so I'll try to speak even faster so you can hear me more. Can you hear me? Just to check.
We can hear you, yes.
Okay, great. So in our survey, we find that 60% of institutions, of financial institutions, had made some type of update to their credit models. But just 1 out of 7 added capabilities that were significant in terms of integrating alternative data or machine learning risk assessments in their models. So most of it was still kind of fairly manual updates. And preliminary evidence so far shows us that innovators that have invested heavily in these technologies performed really well through the crisis. We cannot say better because the comparison is challenging, but really well. And one example, there was a chart. If you move to the next, I think it will appear. Yeah, one example is one of our clients, Confio in Mexico, which is a kind of fintech lender that uses, before the crisis, used electronic invoicing data and payroll information to reach small firms and lend to them. And we see essentially the Confio over a 1.5 year period essentially doubled its monthly loan disbursement. And this is happening after an initial drop in lending following the early months of COVID and a fairly rapid effort to adapt its algorithm to integrate new data on the impacts of COVID-19 on subsectors and rapidly return to growth. So we've seen many more of those examples coming across. Another area that we identify is that lenders can adjust and diversify their product offerings to clients. And this can be done in many ways, from reducing loan maturities, which can improve visibility, to strengthen kind of product features that can help improve recourse in the case of non-repayments. For example, leveraging alternative forms of collateral or enabling automatic payments for loans from existing cash flows. So another example that it's very much in the press these days is the question related to embedded finance and supply chain finance that can be particularly effective in terms of helping with some of this visibility. Here, my bank is it's a bank part of Ant Group in China that is focused on micro and small enterprise lending. And the example here is how this institution was able to keep growing. I mean, you don't even see COVID in their expansion growth. They were able to keep growing the amount of MSMEs that they reached and the loans that they were able to provide to MSMEs during this period, thanks to an integration with the e-commerce platform and the payment platforms that are part of the group that were allowing them unique visibility, but also unique recourse opportunity. So I'll stop here. I thank you for your attention.
And if I may take 1 minute to finish up, the fourth area that we talk about is delayed resolution of distress, elevated risk of sovereign debt, which should not be shortchanged, but I know so many other presentations today were on the topic. And simply around that, in many countries, both the crisis and the subsequent war in Ukraine, etc., have exacerbated and exposed deteriorating sovereign debt quality. And we've also been seeing drops in government revenue that might pose a risk to banks through the bank's high exposures to government debt. And so the importance for these countries to prioritize our global guidance on how existing debt burdens can be managed more effectively, to free up more resources that might be needed for the recovery. And also to avoid and mitigate the significant social and economic costs of sovereign debt distress, which have been research has shown are associated with a wide assortment of economic problems, ranging from prolonged recessions to high inflation, which can have disproportionate negative effects on the poor. So, for example, as shown in research by Carmen Reinhardt and others, it takes on average 8 years for countries to emerge from a sovereign debt default. Effective debt management requires debt transparency, again, going back to the theme of better governance, full disclosure of claims and contract terms, contractual innovations, such as collective action clauses and insurance for borrowers against natural and climate-related disasters, and appropriate revenue mobilization through sound tax policies that also strengthen incentives for businesses to formalize. So please, the report is available. Oops, I'm sorry. The report is available on our website, and I encourage you to dig deeper into the report's findings. So thank you very much.
Well, thank you very much, Laura and Beniamino, for this really interesting presentation of the report. And I'm particularly, as a typical Finnish happy taxpayer, I'm particularly happy with the ending on taxes. Next, I would like to introduce our speaker, next speaker, who is Abram Stagem. He will give a short comment on the report, and then we can open the discussion. Abrams is a research associate here with the UNU-WIDER. He is an empirical development economist, focusing on fiscal capacity and development aid and on the application of time series methods. And as I was reviewing your bio, I noticed that you really have a broad experience with everybody here today, as you have before also worked at the World Bank and with the ODI. Abrams, please go ahead.
All right, thank you, Amy, and nice to see everyone again. I remember Shakira when I was in ODI. Sanjay, I didn't meet when I was in Nottingham, but we may have crossed paths, but I didn't know him then. So, and I'm very happy to be here. I think I've learned a lot from the debt discussion since morning. I mean, the most important of which is that there's too much debt around the world. And we may go back to the barter system pretty soon, but let's wait and see. So I'm happy to have had the opportunity to discuss the World Development Report. It's quite long and interesting. A lot of the discussions or a lot of the knowledge in the report is on financial instability and most of the aspects related to the financial sector. So I wasn't going to spend, or I'm not going to spend too much time on discussing that. I would focus more on debt. And as Amy said, on the aspects of tax policy and tax administration. So this is the structure of my discussion. I would emphasize a bit on the uniqueness of the COVID-19 pandemic, some brief discussion on the interconnections between sectors, the recommendations which emanated from the World Development Report, and another aspect which I'll call the medium-term fiscal reform plan, which is basically a kind of reform plan to enhance fiscal space to be able to deal with the debt problems which are mounting. So the uniqueness of the pandemic, as if you go through the report, as the first diagram, in the discussion showed, economic activity contracted in more than 90% of countries. So it resulted in the following issues: financial instability across countries, over-indebtedness amongst households and businesses, reduced access to credit, and rising sovereign debt issues, so in terms of debt distress, and especially based on the composition of the debt. There was an increase in internal debt, but also a very large increase in external debt, especially foreign currency denominated external debt. Various policy responses were implemented, ranging from fiscal to financial sector policies, but crucially, the efficiency of these policies depended on pre-existing strengths of respective countries, and by that I mean the strengths of their institutions, and equally importantly, the level of fiscal space available in the countries. If you go through the report, you would find that the advanced economies were able to respond better and faster to the crisis than, the more developing countries, especially low-income countries. So this is an extension of the conceptual framework. So on the left, you see what they refer to as a vicious cycle, and on the right, it's a virtuous cycle. So the blue is for the government and central banks, the red is for the financial sector, and then the yellow is for households and firms. And as you can see, there are very, very strong interconnections between both. So for example, lower tax revenue resulted in declining fiscal support for distressed households and firms. It also resulted in counter-cyclical government spending, and especially the difficulty in managing sustainable debt, and also the government not being able to incur the state contingent liabilities from inefficient state-owned enterprises. On the right, it's a virtuous cycle and all of the happy things about a country. And I think we had a conference in May on development and peace, and there was this nice blog about creating the next Finland. So I think the next Finland is some of a virtuous cycle. So we're happy to be here. So higher tax revenue, stronger fiscal support, and again, it leads to the ability to manage government spending, and the ability of the countries to manage their debt and also their state contingent liabilities. So essentially, moving from the vicious cycle to the virtuous cycle depends crucially on debt restructuring, but also on the medium-term economic and fiscal reform plan. So these are the recommendations from the report: managing and reducing loan distress, improving the legal solvency status, ensuring continued access to finance, and one which I found particularly interesting and which I focused on, managing increased levels of sovereign debt. So sovereign debt or the debt stock in many countries was already considerably high even before the pandemic. A lot of countries, especially developing countries, were borrowing a lot to be able to fund their development objectives and even to fund their what you can call pro-poor spending in terms of the wages and salaries being paid to their workers. The increased debt levels became a problem, particularly with external debt. So the composition of debt was also very important. You could get bilateral debt from the bilateral donors. For example, the French-speaking countries in Africa get a lot of debt from francs, multilateral debt from the multilateral financing institutions, and also the Eurobonds. And the Eurobonds are particularly important because how they are used is very important in how they can be repaid. So if the Eurobonds are used for less development spending, then you have all sorts of risks in terms of interest rates, exchange rates, and also rollover risks. The high risks of debt distress in sub-Saharan Africa prior to the pandemic were really exacerbated by pandemic-related spending. Again, because the countries were borrowing at higher average borrowing costs, sometimes more than 5% on interest, it resulted in a very large increase in their debt servicing ratios, which constrained their fiscal space and made it almost impossible for them to respond to the inequalities of the pandemic as fast as the advanced countries. So the G20 Common Framework was created for debt restructuring, as well as the Debt Service Suspension Initiative, which was introduced during the pandemic for countries with liquidity issues and which needed debt treatment. So I just copied this diagram from the report. My focus is on the red one, which is for low-income countries. So as you can see, the share of debt to GDP has been increasing in low-income countries right up to 2020, which is at 67%. The debt being collected by advanced countries is higher than low-income countries. But again, because their debt or their borrowing costs are higher in low-income countries, you would find that the debt servicing costs in low-income countries are quite high. I think that's going to be a fundamental part of the discussion tomorrow on the 2020 Financing for Sustainable Development report. So we look forward to that. So the soaring debt service costs across countries and much higher in low-income countries, it reduced the funds available for spending and it exacerbated inequalities in those countries. Debt restructuring is crucial if countries are going to be able to manage their debts, and the IMF and the World Bank are crucial in this procedure because they provide debt sustainability assessments, which are a natural first step in trying to restructure your debt. The Common Framework, or the G20 Common Framework, and the DSSI were also created to help countries. So the Common Framework can coordinate rescheduling for countries with sustainable debt, but with persistent liquidity issues. Coordination amongst the creditors is also very important because it involves multilateral creditors, the Paris Club creditors, and also the non-Paris Club creditors. So in as much as the development institutions may be inclined to coordinate and suspend debt service payments, sometimes the private creditors are not inclined to do that. So coordination in terms of how the services, debt service can be suspended, is very important. So this brings us to a medium-term fiscal reform plan in terms of creating more fiscal space to deal with the scarring effects of the pandemic. So managing soaring debt stocks, which I've discussed above, prioritization and efficiency gains of spending, and domestic revenue mobilization in terms of tax policy and administration reforms. So improving efficiency of government spending, it has to deal with an improvement in public spending efficiency and the quality of public procurement. So this can be done through digital public financial management solutions in terms of fiscal transparency portals and digital procurement reforms, constant auditing of government processes and spending, and also in terms of beneficial ownership. All of this within the backdrop of transparency, accountability, and good governance. One thing which happens during a crisis is there are a lot of parallel systems of spending created. And if the efficiency of spending has to be increased, then accountability and transparency are of utmost importance. There was a very big scandal in Cameroon in terms of the amount of money which was disbursed by the IMF for COVID. And the presidency handed it to the prime ministry to handle, who then handed it to the Ministry of Finance to handle. And it was a very nice vicious cycle and a loop in terms of pointing fingers, and nobody knew where the money went to. So there are auditing processes going on now, but I wouldn't hold my breath. So tax policy and administration reform. So this is actually very crucial because we talk about debt and other innovative methods of financing, but those are external and sometimes they are not within the control of the countries. But in terms of your tax policy and administration reforms, the countries are actually in control of that, and which I think huge strides can be made into improving our tax policy and our tax administration, which is going to lead to enhanced tax capacity and hence more tax revenue as a share of GDP. So this can be done by targeting on the taxed basis, such as excises, property, capital income, as well as exploring untapped bases in terms of carbon emissions, as greenhouse gas emissions, and also the digital economy. Increasing the fairness and progressivity of existing tax systems, especially capital income, because you have all these high net worth individuals and these strong multinational enterprises that can easily move their tax liabilities from high tax in countries to low tax countries, and that really has to be catered for. Which brings us to the next point, rethinking international tax rules to stop avoidance by multinational enterprises and high net worth individuals. Developing tax policy to meet other broader objectives like climate change and health. So again, this takes us back to the discussion on carbon emissions, which, as we are seeing, we are living in an existential or potential crisis, which is going to involve the climate, and developing tax policy now to be able to align itself with those climate objectives And other health objectives, like in terms of obesity, you can talk of excise taxes and the like. That's also very important. And finally, improving the facilitation and enforcement in tax administrations. And digitalization is going to be key here, because in a recent World Bank report, it was found that countries that digitalized their tax administrations before the coronavirus pandemic responded much better and much faster than countries which were still dealing on the paper-based system of tax administration. So I think this brings an end to my discussion. Did I use all my 5 minutes?
Yes. Okay. Thank you very much, Abrams. Now it's time, we have some time for questions, comments. Who would like to start? Over there.
Thank you. As always, very comprehensive report. I'm Iikka Korhonen from Bank of Finland. The one thing that struck me was how differently the non-performing loans performed in low-income and lower middle-income countries vis-a-vis rest of the world. And since I don't remember if the GDP outcomes were that different in that group of countries, is it because of health outcomes, meaning that these countries probably had were the last ones to have access to vaccines, and hence the normal sort of functioning of SMEs and service sectors, for example, would probably be hampered. Yeah, I don't know if you have any insights on this. Thanks.
Laura, would you like to answer that?
Sure, Benny, you're welcome. Jump in. One thing to remember is that, sorry, there's an echo. You can control the echo. Thank you. So, one issue is also that during the pandemic, especially in lower middle-income countries, governments and central banks implemented regulatory forbearance, which allowed firms to not repay. And so there's one question around the moral hazard of whether firms, figured they didn't have to pay at all. And so that now that the books are being opened and the transparency is being, there's greater transparency into the true performance of many of those loans, we're getting this sort of bubble of non-performing loans. And the second piece, I would say, going back to the story around digital payments, in many lower income countries, so in many high income countries, digital payments became a lifeline, especially for small businesses who were able to pay between delivery and remote online purchasing, which often wasn't available in lower income countries, which might also have led to a slower recovery. Benny, do you have anything else?
Yeah, maybe I'll add. So the best line of interpretation I can find is that, first of all, in upper middle income countries and high income countries, firms were likely to have a stronger cushion or stronger set of assets to face the crisis than in lower income markets. Policy support, as Leora said, was significantly more intense in high and upper and middle income markets, both in terms of direct transfer as well as the forbearance work. So it's very possible that some of those NPLs in upper middle income countries are simply not yet seen. It's not that the businesses are doing better. But I would bring those two. I don't think it's about the health outcomes being differentials. As a matter of fact, as far as I recall from the last time I looked at the data, the health outcomes might have been were worse and more deeply felt, both in terms of health outcomes, but also in terms of the restrictions to the economy for higher income markets than the lower middle income ones. Thanks.
Thank you. Other questions, comments? Anybody else? We could take a few. Okay.
Thank you, Arnhan, IDRC. I have when the pandemic started, there was a lot of talk, as happens to be the case in emergencies, about building back better. And I think we've discovered that a lot of those haven't happened. In my own organization, we introduced a new system for claiming expenses. And people tested during the pandemic, and now we started traveling. So it's not working. Because we tried it out during the pandemic, and like some of the things actually weren't a particularly good idea to introduce during that emergency. The list of recommendations, and this is also to Abraham because of his comment he made on Cameroon. The list of recommendations are, and as you said, most of these were the case before the pandemic. They're equally relevant, but I'm particularly keen to hear what you would recommend now, and particularly at a time from the international financial institutions when so many countries have to restructure the debt and IMF loans, have certain conditions. Is it the right time to focus on these, or is it exactly the right time for some of these I can see, or would the recommendation be let's get through this crisis first and then address those? And of course, that may be different for the long list of recommendations, but I'd really love to hear a little bit more at this particular time, at a time of crisis, what the priorities should be.
Thank you. And Rico, we had another one here, and if there's any more, okay. And one more from
So I'm Kunal Sen, and thanks so much for a very interesting presentation, Leora and Benjamino. I wanted to kind of raise the question that actually Abrams raised in his presentation. Given that now a lot of and there's the last point you made later in your presentation on sovereign debt, given that most of the sovereign debt is now owed to private creditors, how do you get them around the table when they really have very little interest to do so, when there's a collective action problem? So what kind of incentive compatible mechanism can one think about to get private creditors on also talking to the Paris Club and others and European country governments, when you might argue that from their point of view, there really isn't any reason to have these discussions? Thanks.
Mm-hmm. Thanks, and then we had one more from here, and with these three, I will hand it over to you.
All right, thanks, Michael Dankwa, UNU-WIDER. Abrams, you did talk about the DSSI. I just wanted you to, throw some more light on that, and why that many the developing countries, why many of them did not take advantage of that. I mean, I know a couple of countries. Why is that so? Yeah, thanks.
Thank you, and Laura and Benjamino, if you could start, and then I will give you the last words.
Take the hard ones, Ben. So yeah, now, around the sovereign debt question, I'll just provide the answer that especially private creditors, transparency is a greater problem, right? So certainly the World Bank has been working simply to encourage greater transparency around total debt, which is critical in understanding governments' true obligations and vulnerability. Regarding the question about building back better, which is our own organization is guilty of reusing that phrase. Many of the recommendations in the report, this is an opportunity. So for example, as I mentioned, India, Colombia, many other countries during the crisis introduced almost like a Band-Aid, but temporary out-of-court mechanisms for small business bankruptcy proceedings, which is really important, right? And so this is a mechanism that was sort of brought out of necessity because of the potential overwhelming of the court system, but has proven quite effective. So this is something that can be continued, as well as just many of the other recommendations around establish and which again. It was the Churchill never waste the opportunities, but never waste a good crisis. Many banks have instituted non-performing loan departments to address vulnerability, late payments, for example. And these are the type of institutional changes, which the hope is will be continued and built up after the crisis. Although, I think it's important to say that we're not in a, we had, when we wrote the report, we expected to be in the recovery stage now and helping countries in the recovery. Whereas unfortunately, there's still tremendous urgency around many of these challenges, especially deteriorating real economic conditions.
Benjamin, did you want to comment on something or?
Maybe just adding one quick point. Sorry, I know we're already over time, but with respect to this last question that Leora addressed, I think we do notice a couple of things. First of all, much like governments, economies that already had made significant progress in terms of digitization of payments and digital infrastructure, still benefit from it. Others, we are actually seeing went back to cash in a way. So some of those solutions, some economies were not ready to adopt in the long term, and so that certainly is a sobering consideration. The other one is that with the tightening of the funding environment that has happened over this past year, a lot of the innovators are actually finding it harder, especially the new entrants in markets that rely on capital markets, finding it harder to grow at the rates that we had seen even in 2021. So again, another I guess not necessarily a response, but another acknowledgement that as the world, as these crises continue to evolve, so does the kind of the set of recommendations. Maybe last point, from the very beginning when we worked on the WDR, we acknowledged that with an ongoing crisis, there wouldn't be a package of recommendations that would be fitting, all markets. And Leora led a set of conversations with our regional offices, fairly individualized to try to kind of tailor some of the recommendations, region by region, country by country, because ultimately, there's the report is so long, and the list of issues and the list of recommendations are so multifaceted that they need to be tailored to each specific context.
Yeah, I guess to follow up what Benny said around so building back better. For example, when we talk in the credit section with this, there's a massive adoption of, for example, digital merchant payments during the pandemic. Fintechs entered to be able to offer safer, less risky credit products that are tied to the digital payments flow, both as a source of real-time economic information, as well as often being paid back directly from these digital payment flows, reduce the repayment, recourse risk. However, as Benny mentioned, we're quickly seeing, especially in places like Latin America, merchants returning to cash. And that's because of the underlying, going back to especially issues around taxation and formality. And unless countries address these underlying challenges, firms and business won't be able to take advantage of some of the more innovative technology-enabled credit products.
Thank you. Abram's short comments.
All right. Thank you, Michael. I was kind of hoping my question was going to be on taxation, but I think if I were to surmise, I think it's going to require some country-by-country analysis. But one thing you need to remember is that the DSSI was always temporary, so it may have eroded the incentives of countries to, request the debt treatment from the creditors, because the G20 common framework depends crucially on requests from the debtor countries. So they don't just come and then force some treatment upon the country. No, you need to request the treatment from the creditors, at which point they'll do a debt sustainability analysis, from which they'll determine how your debt gets restructured. If I were to guess, I would say the temporary nature of the DSSI ensured that the countries were not going to request any kind of debt treatment. The Africa's Pulse, which is the flagship report of the African region of the World Bank, showed that even the benefits from the DSSI was going to be like 1% of GDP, which was pretty much trivial, which might explain why the countries didn't request. But if I were to guess, I would say it's because it was temporary. They had to request, debt treatment from the creditors, And which also brings us to collective action problems, like Kunal said. A lot of the creditors are non-Paris Club creditors, and maybe the debt contracts have some binding clauses which make it very difficult for the countries to request. But that would be my guess. Yeah.
Mm-hmm. We have run out of time, yes, so that's what we are being. Let's continue the discussion over the coffee, but before that, thank you very much for our presentators. Let's give them a round of applause.
Okay. Let's start the last session of this today's program, and we will have Bengt Holmström from Boston joining us. Bengt is the Paul Samuelson Professor of Economics Emeritus at MIT. He is best known for his theoretical research on contracts. He has made fundamental contributions to the theory of the firm, to corporate governance, and to liquidity problems in financial crises. In 2016, Holmström was awarded the prize in economic sciences in memory of Alfred Nobel, together with Oliver Hart. Holmström has served also in many non-academic roles. I want to mention his less known role in providing independent advice to the Finnish government. That work has started in 1992 when he was with Seppo Honkapohja, the key members in an expert group that prepared economic policy strategy for Finland after a deep recession in the early 90s. And his last contribution for policy was in the context of the COVID-19 pandemic, when he was part of an expert group that prepared a policy strategy for the pandemic, economic policy strategy under the pandemic. Holmström's results are often surprising, the research results. However, they are readily understandable and they have a sort of clear intuition, and they are also based on realistic assumptions. I think we can wait also this time something surprising, something interesting, something exciting from Professor Holmström. Bengt Holmström, welcome to this workshop. This is last session of the first day of this, and we are delighted to have you present from Boston in this workshop. Please, the floor is yours.
Thank you, Martti. And thank you for inviting me to this conference. I'm very pleased. I would have been even more pleased to be in person there, but this is the reality today. I'm going to talk about a topic that I have studied for since the great financial crisis, 2007-2009. It was work that I started in those days, and so some of you probably have heard some version of this or something very similar. I apologize, but I still think that for this audience, I checked that for this audience, this may be containing new ideas. So that's what I'm presenting, and basically I'm going to lay out the reasons for the financial crisis, and then finally come to at the end come to talk a little bit about the effects it has through digitalization on emerging economies, how this perspective is affecting it. So let me get, I just have to, I don't know why it's not changing the page here. I'm a little bit unfamiliar with this Teams. We use Zooms. Can anybody there in the technical side say what I should be doing? It worked just fine when we tested it yesterday, but now it's not moving.
If you try
Okay,
to...
now I see. I have to press. I have to wake it up. Okay, thank you. So let me start by the crisis itself in 2008 when it broke out, and people. That was a shock because we had 70 years of without a crisis, so nobody even expected that in a developed world like US and then subsequently in Europe that there could be a crisis. So the instant reaction to the causes of the crisis were many, but by and large it was the criticism fell on Wall Street and Wall Street greed and wrong incentives and securitization created complex, opaque asset-backed securities that nobody really understood what was in the bags of chopped up small pieces of mortgages, and then the ratings agencies got an earful and for having been careless. I often mention Michael Lewis' The Big Short. Some of you have seen the movie. He asked what I think is the key question, and that is that how could Wall Street trade without knowing really anything or so very little? In his movie and his book, he lays down the fact that they kept trading on Wall Street, but very few people seem to know what these different very big-sized trades were worth, and so the first instinct was to call for more transparency and so as to avoid this crisis. But I want to present an alternative view. I think that's the question is right. Why didn't Wall Street know anything? But basically, I'm going to put forward an explanation why they didn't. And that is that in money markets, as these markets are, that is very short-term debt. They are repo markets. They are short overnight treasuries and treasury bills and so on. They are these very short-term debts that get rolled over frequently. Huge, by the way, size of this market is many times larger in terms of dollars than say in the stock market. So stock market gets all the attention, but these money markets are gigantic and global. And so I'm putting forward the notion that no questions asked is liquidity in money markets. That is, they were very liquid, and the only way they were liquid was that one didn't have to ask any questions. And Badgett was an astute observer of banks. He was a banking expert. He said already in the middle of the 19th century that every banker knows that if he has to prove he is worthy of credit, that is, if he has to become transparent, in fact, his credit is gone. So another way of putting it is that ignorance that people don't know, they just don't have to ask questions, is almost bliss in money markets. And that's the opposite. So it's not, transparency is not going to solve the problem in a way that people imagine. And the problem here underlying this sort of view has to do with the fact that the stock market is very dominant in people's minds, because the stock markets are exciting. All sorts of things happen. In money markets, when they are working well, nothing really happens. And people are very unaware of what's going on. So I'm going to make the thesis, or one of the key theses I want to say is that stock markets and money markets are very different, almost each other's opposites, and therefore one should draw lessons from stock markets to deal with problems in the money markets. That's one of the main lessons. Let me just say that why isn't transparency important? So there's sort of common but false inference, and that is that somehow transparency will make us believe the same things, when in fact very often it's just the opposite. So symmetric information about payoffs, that is the payoffs from the instruments, that's important for liquidity. Everybody agrees on that. But transparency does not imply symmetric information. In fact, it may be, and often is the case, that if we make something transparent, then parties that watch that same information actually start to believe something very different. So imagine that you are buying a car and you look at it from a long distance, and there's a mechanic next to you that's bidding on the car also. So these are typical forms of bidding. Then if you know that the mechanic has seen the service book and looked at the hood and driven the car, then you don't want to bid against him because he knows a lot more. He understands what this means. But if you look at it from this long distance, which they usually do, that is sometimes they just flash the car and then you have to bid. That makes the uninformed person about cars, put him in the same position as the mechanic. So actually hiding information in cases of expertise, varying expertise, is very important. We process information so differently because we have different experiences. So there are two ways to symmetric information. Investors know everything of relevance, for instance, the stock prices or something like that. That's what the stock market does in terms of getting symmetric information. But symmetric ignorance that you are going to get through over-collateralized data, as I will show, that's a much more common way of actually getting to symmetric information, especially in money markets. So these are the main theses. So why debt? It's a good question because we get always in trouble. All financial crisis has to do with short-term debt, sort of breaking down. So why are we at all playing with debt? And the short answer is debt is cheap. It's a cheap way of lending. And so this goes back all the way to pawning, which is thousands of years old. The oldest documents of pawning are from China, in the 600s. And so on. So why is pawning so efficient? And that is because it doesn't require very much information, and it especially doesn't require that we agree on the value of the pawn, that is the item that's being pawned. So haggling over a price, if I try to sell something when I have a liquidity problem, then maybe I value it more than Marty or anybody else, the pawn shop. But or we have very different views about, what this is. Maybe it's my grandfather's watch or something that has emotional value. So the solution to this problem of costly selling and haggling over the sales price is this very clever solution that the pawnbroker buys the pawn, and he literally buys the pawn at a safe price for him. So, if I think it's $500, the pawnbroker may offer $50 or $100 or whatever. On one condition, I accept this trade, and that is that I'm given the right to buy back the pawn. So if you only offer me $100, then in a month I will want to be able to buy it at $105 or whatever the added interest rate is there. And the key point here is that this is all designed to avoid price discovery. This is the key. This is what makes debt so cheap and quick, is that there's no price discovery. The repo market is the world's biggest, most liquid market in a money market. And I'm talking about the US, but repo markets are elsewhere also. It is actually almost the same as the thousands of years old pawning. It's a little different in that it may be the pawn shop that wants to park money with somebody, but otherwise it's a modern day version of pawning, and the basic logic is very similar. So let me say a few words looking at it a little differently. The design of the debt is designed to be information insensitive. It's not just to overcome this problem of having to buy or having different information or valuation of a pawn. It's also the fact that when you look at broader areas, the market for debt, especially the short-term market, then it's designed to be so that you don't have to ask any questions. And this is a picture, for some it means a lot, or it's simple. It's the red line is the payoff from the collateral is placed to support the value of debt. So there's a face value of debt, say 100, and there's collateral that is worth more than 100 in order to secure the debt. And the more you have collateral, the more you go to the right in the red, the red line goes to the right. That is the value of debt as a function of this collateral value at the time of expiration of this loan. So the red line is the market value of debt at expiration. And then the thin black line is market value of debt looking towards the end. That is, if it's 1 month left to go, then it's below this red line because it's an option. It may go into default. And it eventually, the more collateral you have, the more valuable the collateral is, then eventually it's tangent with the red line. So it's 100, if it's the case that there's a lot of collateral underneath it, plenty more than the face value of debt. And that's the information insensitive region. But if something happens and we get into closer, the collateral value falls, as we will see shortly, then we get into the information insensitive region, information sensitive region. So that's the basic idea. Let me just mention that one of these things is purposeful opacity. If you actually start thinking about this, you see that De Beers sells diamonds by basically putting them in a bag, and you are not allowed to look into the bag. So it makes it more liquid. And credit rates are coarse, and money market funds have delayed information release, and so on and so forth. So let me say what the problem with that is. I don't have that much time, so I can't elaborate on these things. There is a very dark side of that. And that is that relying on debt, on securitization, coarse ratings, mechanical rules for valuing this. The rating agents used very mechanical rules for valuing these securitized products, the ABSs and MBSs and so on. That all makes good sense in good times. But there is one concern about it. You don't remove any risk by making it more collateralized. The fundamental risk underneath is it pushes risk into the tail. I should have not said that. More collateral will reduce the risk, but it will push the risk into the tail when you make a debt contract. So you would make it very safe in the flat region when as we say, the debt is in the money. But if it ever goes out of the money, that is, it goes into the red region and into the information sensitive region, then the risk gets bigger. So the social trade-off in some sense is everything that enhances liquidity increases also the severity of tail risk. So you can get more of it. For instance, you can shorten the duration of the contract. That's going to make it more, the red region, or the information insensitive region larger. But if it ever goes into a crisis, then it's going to cost you a lot more. So one way of I'm going to have to jump over this thing, but one important thing, if one asks what happened in the financial crisis, is that it was assumed that diversifying in debt markets is a good thing. That's one borrows from the stock market the idea that full diversification really makes this safe. It's true that so here is an example that if you have 10 identical banks, each holding, say, 1/10 of the total portfolio of the debt portfolio of a country. So everybody has identical portfolios. They are fully diversified, just the way stock markets are the stock market advises. Then you realize that if every bank has exactly the same portfolio, a slice of the same portfolio, if one bank goes down or its portfolio breaks the buck, so to speak, that is, it isn't fully valued, then everybody does it at the same time. So the banks are perfectly correlated in this case. So this is an example of how the logic from the stock market has absolutely the opposite consequence. And Pre-crisis, people believed that even though debt levels kept increasing, they said, well, it's very well diversified. Actually, that's a disastrous thing on the whole for if it goes, to a very extreme case. And this has been proven, exposed empirically, that actually this was a big reason. Things were correlated too much. So I jump over this. It's this shift for information. It's when the distribution shifts from information sensitive to information sensitive. Here you see one illustration of what it looks like. Let me just say that this is actual trading data from money markets, but it shows the left line is very stable. And these trades are just clustered around, that is, they are all made roughly at the same price with small variations. But then when the bear fund collapsed in July 2007, so it was a year before the Lehman, or more than a year before the Lehman, you can see how there was total confusion in the market. And the prices just spread. Different parties bought at different prices. They were not at all uniform, the prices. So this is an example of what happens when you end up in that tail, where the money, when the debt is believed to not be any more worth 100, it's something less. But no, because there never was a price discovery of the tail, of the actual collateral value, people are totally confused about it. Here's another picture that you see. This is 2008. You see how steeply, they kept issuing more and more debt, structured products and more debt. These are different varieties. I don't go into it. You just see that home equity loan is actually the biggest. So this talk about, these subprime loans, they played basically no role in this whole story. But this whole market dried up. Nothing was issued. And it's interesting to note that in money markets, you see, because there is no price discovery, it's always quantities that adjust, haircuts, or in this case, we don't issue anything more, and so on. So again, this is very different than in the stock market. So people were really puzzled that nothing traded for a while after the Lehman crisis. But how could we not find some price at which we can trade? And the answer is the adverse selection was so severe that people had such different views about the prices. And they were afraid that others knew more than they did. So the summary of the view of this view that I presented is that money markets and stock markets are two polar systems of liquidity provision. They are both liquid, but in very different ways liquid. In money markets, they are urgent, trillions of dollars of repo rolled over every day, in those days especially. Everything is information insensitive in the sense that there's no price discovery. Nobody knows anything expert-like really that is of value for trading. And there's just a shared understanding, and it's trust-based. So it's a no questions asked environment. And that's the answer to Michael Lewis's question. Why didn't anybody ask any questions? The answer was because the market was working well. And that's the sign of a market working well. If somebody asks questions in money markets, we are already in trouble, just like Badgett suggested. Stock markets are very different. You can wait for trade. Money markets, you have to trade. You have to roll over these debts every day. So it's if somebody stops trading, like J.P. Morgan did in the case of Lehman, it's a heart attack. And because you are thrown into the situation where you have to try to find out prices or start a market where there never was one price discovery market. It's information sensitive, so every piece of information matters. There's very accurate and continuous price discovery. And it thrives in some sense. What drives this market is that there is all the time information coming in and people have somewhat heterogeneous beliefs. So there's people that can make money on these trades. You don't make money on money markets because everybody believes the same. But when you have different beliefs, then you can make, for short periods of time, you can make money. So this is what the stock market is, and here transparency is critical. Here, even today, we are talking about nanoseconds mattering, and so it's a very intense, very expensive market relative to money markets. Money markets cost very little to run. But loans are made, these trillions of dollars of loans are made in snapshot, in very short periods of time without any information. The stock market, in order to get started, for instance, really requires a lot of, if you want to do an IPO, you have to build a book. It takes months sometimes to do it, and so on. So it's an entirely different. Let me emphasize, money markets are very liquid because they are two-legged. That is, there is this pawn shop logic. So it's what we call a two-leg market, and it's a primary market. The secondary market, when bonds, for instance, are issued, then you have to find the price, because if you are trading bonds, that's a price discovery. You need to know exactly the price because it doesn't have that second leg, and those markets are highly liquid, and in fact, most bonds are not traded at all. So this is all to say that we need to understand. So this insight from the information view that I described is that it answers the question, why didn't people ask questions in good times? Because that's the way it's supposed to work. Why ratings were caused? Because that helps us have the same beliefs. If you start to provide detailed information, then experts become better than other experts. So you're hiding information. It also explains why it was so chaotic when eventually the money market funds broke the buck. The role of government in crisis, it has a very simple implication. Even at this level, you right away, when you understand it, you understand that the key is to get back to the no questions asked state. Trying to sort of buy up toxic assets as the US planned to do initially, with the $700 billion that they got from Congress, it would have been a disaster because you would never have known whether all the toxic assets or sufficiently many toxic assets had been bought up. So they abandoned that plan that they initially had and went into the idea of just recapitalize the core of the 19 banks, big banks, 80% of the banking system, recapitalize those banks. And there they were transparent for a while by showing that if we pour in this, I think it was less than $100 billion that eventually they put in, they said that's enough to get us back into the no questions asked region. After that, it became more or less non-transparent again. So we have stress test regulatory considerations are we got higher capital ratios, we got liquidity ratios, which I think are very questionable and partly a cause of the troubles we are seeing right now. So I'm not in favor. I won't go into it now. You can ask questions about it. But stress tests I'm very big in favor of. But I'm not sure these stress tests should be as explicitly revealing as they are. That is, I think they should look like elevator tests. They should be people coming, repairing something, but they shouldn't put on the wall that last time we repaired it. These cables were almost broken, and it could have fallen down, and so on. You don't reveal that. You just said it's fixed and it's good. So, and then the third thing to keep in mind is that transparency, if you want to reduce liquidity in money markets, then you can put in information so that experts come in, and that actually excludes a big bunch. And we saw it actually in the money market funds nowadays. They became more revealing after the Dodd-Frank transformation. And just like this theory predicted, half of the money markets actually ceased to exist as money markets. They became just trading markets of different kinds. So their sort of moneyness disappeared. So let me say a few words about the big data, because I know BOFIT, your people who are working in the area of emerging economies, and so I'm very excited about the big data. It's an entirely new form of inclusive financing or financing And it goes against the idea of just putting collateral in. It's, as I put it, information is becoming the new collateral. So it's reversing the idea that information is expensive and collateral is cheap. In the cases where we are trading on big platforms and getting data sort of for free in some sense, then we can do some very different things. So the leader in this area, I think, is clear, and that's China. But many other developing markets have also, Africa has had, but China is really, in terms of volume and sophistication, it clearly leads the world. And the reason they are the leaders have to do with having been behind. They never used checks. They didn't have PCs, for instance, the computers. They went to mobile internet almost directly for most people. They went from cash to actually paying with mobile phones directly. And so this being behind has allowed them to leapfrog Western societies. So they are by far the most advanced in terms of payment systems. So these payment systems, which are brought from the platforms of Alibaba and WeChat through their Alipay and WeChat Pay, are basically the main payment systems available in China. You can't go there with cash. You can't pay with cash anywhere. Even beggars use Alipay and WeChat Pay. So the payment systems, everything gets recorded. And there's massive amounts of data, and upending the traditional substitution, that information is expensive. It's very cheap. It comes for free almost. So as I said, information is the new collateral. And mobile credit is superior version of credit cards. So Alipay, for instance, they have also a credit line. It's not that you apply for credit. So that's an interesting feature. You just get a message into your phone and asking, do you want to increase your credit line, so to speak? That is, do you want to get we have evaluated you basically, and we have found that you are good credit. So here is an offer to get credit. So it's similar to the Western world, but you can't apply it at all, and also everything happens electronically and without any human interaction at all. So it's called the 310 system because it takes 3 minutes to deal with this message. It takes 1 second to get the money into your bank, and there's zero human involvement. And one of the things Alibaba uses as a slogan, they know you in the sense that they have to know you in order to give you credit, but they don't know who you are. So it's based on, partly at least, on the pseudonyms, which is a future that the West have started to explore. The idea that we have a second identity on the net, that is, say, a number or social security type number or something, but very few know how the mapping from that number goes to our actual personal information. So this addresses partly the concern about privacy. The enforcement mechanism is very sophisticated, and it's by the exclusion and continuous monitoring of fraud. That's one thing. But exclusion is very important because there are only 2 payment systems. So if you somehow get excluded from the trading platforms, a lot is taken away from you. So there's very little fraud in principle, and people behave, and they are. These algorithms that evaluate people based on how they purchase things and what they are doing on the platform and how they are trading with each other, all the information is in some way used. Who are you? Who are your friends? Who are you dealing with? And so on. Sounds horrible, but actually it's very informative. Let me just mention that even if you just tell that, do you have an iPhone versus an Android phone? That already is informative in forecasting whether you will pay back your loan. So that has been tested in America. It's a little scary, and Android people are poorer credit than iPhone, and it has just to do with the prices. So these are dramatically lower costs, and what I find most exciting is this has had a dramatic impact on inclusive financing in China. I mean, the 200 million or 300 million people that have brought out of poverty, this has played a role. This mobile internet has played a big role. And if I may just say, Finland, Nokia has done a lot in this term. It's not talked about much in Finland, but actually they were by far the leading network provider and mobile phone provider in the early days, and had over 50% of market share in many of the developing countries, Africa and India, and even 40% in China. So this is, I think, an enormously valuable thing. Let me mention, and I could talk about it a lot because I've been involved with Law and Academy in China, studying this. I would just want to mention BCAS in Bangladesh, because Bangladesh was very poor, and this BCAS was partly with the help BCAS was subsequently helped by investors like Alibaba, SoftBank, Bill Gates, IFC, and so on. So major investors have become excited about it. But it was established in 2011, so it's only 10 years roughly old. And it now has close to half of the Bangladeshian sort of addressable public customers. And of them, about half is active users. Active users means they use at least once a month these accounts. So it's not just that they can buy things and so on. They also get banking services more generally. They get a bank account. Most people, absolutely the majority, had no bank accounts because they lived in villages and so on. So now they have with their mobile phones, they have a bank account and they are using it, and they can buy products from far away. And again, I say China is far and away the most sophisticated and most developed market. But Bangladesh is you look at these numbers, they live on 11 million transactions and yearly transfers, 40 to 50 billion inside Bangladesh. That's a lot of money for a relatively poor country. Though Bangladesh, I think partly thanks to this, has recently surpassed India in GDP per capita. That's remarkable considering how poor it was just 20, 30 years ago. So BCAS is something that you should be aware of. Let me say that the key point here is that I think there are enormous opportunities ahead. With this microfinance-based behavioral credit scoring that I have described, that you just watch what people do on these platforms, but various kinds of platforms, what kind of insurance they buy or whatever they do, everything is followed. The point is that this is very reliable, first of all, in terms of forecasting how their credit scores are, and secondly, it's very scalable. That is, this is the remarkable thing. You can go, the numbers in China are way over half of Chinese population using mobile phones or have at least access to mobile phones. And India, Bangladesh is coming behind, as you saw, and nothing like this has happened. If we look at the traditional microcredit, where you have these communities that you lend to villages and they monitor each other and therefore they are more reliable. It requires a lot of work to get it set up, and obviously a lot of human work. So it's important. It's just not very scalable, and it's also very spotty, the results, because you need to have skills. And under this author, some of you may have heard his idea of creating new property rights for these poor people. That's just massively difficult to get registrations to do that. So I think by far the best way, the future for eliminating poverty or reducing poverty, and also getting these unbanked people in the developing countries into the periphery of finance, which will bring them out of poverty, is this system that I described here, this behavioral credit scoring system. So I don't know, blockchain technology is going to, I believe, going to make things a lot more secure as well. It's used a lot. There's a lot of discussion about that, but I think I stop here in terms of telling. So I wanted to flag this. Now, this shows you that collateral can be reduced. Let me make one more point. Collateral is still very important. So this sort of mobile finance is mobile lending is not that big a share of it, but it's a very big share of the poor people's purchases. And it's coming actually to the US also, just because it's a lot more convenient than credit cards. The last point I think I had to make, the JPAL there is something that is part of my department at MIT, and it was started about in early 2000, and they have hundreds of these evaluations of these behavioral credit scoring efficiencies. And I think they are pretty excited about this. Thank you very much.
And now questions from the workshop participators. There's really two parts. Yes, please. Two parts. There's the general thing about information sensitivity and so on, and then there's this part on innovation or inclusive innovation, innovative finance. But yeah, please.
Okay. Thank you very much, Professor Armstrong. It was a very enlightening experience for us. Okay. I've kind of two questions. Okay. First one is that, like, say, in your diagram, there is a kind of a default zone and there is a non-default zone depending on the value of the collateral, right? So now, so if you kind of in the pawn shop example, suppose if I give some watch, so the watch is kind of a tangible object, it is kind of verifiable, but when actually in the actual transactions in modern days, shadow banking and etc. So when the kind of instead of the tangible collateral, it became kind of other financial assets, right? So which must be kind of backed on another real asset, right? So isn't that kind of doesn't that create a kind of adverse selection? Sorry, I could be wrong. I mean, if I could understand you, that is in that zone, no non-information, I mean, in that default zone, or what we call kind of a information sensitive zone, right? In the collateral, wouldn't that be a possibility of adverse selection in exchange? That's my first question. And my second question is that, how would you kind of relate to mobile banking in kind of reducing the risk of transaction to enable them, enable lots of poorer people make an entry? So that part is kind of a little bit not clear to me.
Yes, Bengt, please.
So, thank you for giving me the opportunity to clarify the picture. So you are exactly right. There's a underlying value of collateral is on the horizontal axis, and initially we are far in the right side, so that it is information insensitive because the collateral value is substantially over the obligation to pay back debt. That is, if debt is 100, the collateral value may be 150 or so. One of the key points is we don't have to have the same. We know there's enough collateral That's the big sort of reduction in information. But if I asked, what do you think the collateral is worth, or I ask somebody else, we have very different valuations of the collateral. But none of that matters because variations in the collateral value and as it changes over the days and months, perhaps in this case mostly days because these are shorter, then nothing happens to it's still 100. It's still well above the 100. So that's the point, is that's why this information insensitive region is not sensitive to changes or shocks to the value of collateral or even the people's valuations of collateral. So we don't have, we are sort of in disagreement if you asked us about the value of the collateral, but it doesn't matter for the value of the debt or the repayment probability and therefore the value of the debt. So that's in the information insensitive. When information insensitive region, when collateral in rare cases, but as we saw it has happened, the collateral values start dropping, and that's because that causes us to move to the left in the picture of debt, and we are coming, then the thin black line eventually will disconnect from the red line, so it's no longer 100. But let's call it the market value, though there is no market value on it, but conceptually it's less, that it's not worth any more 100 in the minds of people. And that's a moment, that usually I drew it smoothly, but usually you take a jump, something unexpected happens, such as the Bear Stearns default, or somebody breaks the buck elsewhere in the money market fund or something. Those are very shocking events. And then you are right. So getting to the adverse selection, then suddenly it matters that some people know different. We all know different things. So there's massive. We are going from a state of no questions asked. We are all on the same page. We're thinking about the same way in terms of the value of the debt. We are suddenly thrown into chaos because we now realize that it's not 100, but what is it? And we have very different views, and there's adverse selection. I'm not going to touch it because somebody knows more than I am. I'm not going to trade with anybody. And that's actually what happened in the United States. So they had no idea of what the value was suddenly. So did that answer your first question? So on the mobile banking, I think I will have to just defer that question to some other discussion.
No, thank you for clearing, because I understood that is on the horizontal line, whereas information is insensitive. There actually doesn't really matter what is the value because already the loan is covered, right? So, but it is that actually you answered my query kind of very well, because when it becomes in the black zone, the black art zone, that is information sensitive zone. Yeah, there could be kind of probably the market could be kind of the market participant might invest in some information to information acquisition or something like that could happen probably in that zone. In that zone, probably kind of some more action could be happening where the information sensitive zone I'm talking about.
But I'm telling you just the empirical fact. It is chaos most of the time. If it happens in a little place, it takes. If we look at what happened in the 2007, 2009, the crisis really actually started 2007 already. So it was a year sort of simmering, but it was mostly in the over-the-counter market. And therefore nobody saw it. So it was still hidden, but those in the OTC market, they actually saw that something was happening and they got increasing nervous, and Bear Stearns, the firm, had to be rescued by the Fed in March 2008 and so on. So there were kind of shocks, some of them rather significant, but as we saw, the government came in and rescued. So people felt comforted by that, but so it doesn't have to completely collapse, but they will substantially reduced in value initially in the OTC market. The collapse paradoxically came in the supposedly the safest market, which was the tri-party market, because their adjustments to haircuts and such that took place in the OTC market, they didn't take place in the same way in the the tri-party market, because that was overseen. That was more transparent, and it was overseen by these banks, JP Morgan and Boni, as it's called, Bank of New York, and so it was less abrupt. But then the Lehman collapse was a big enough event to get everybody thrown into chaos. And after that, there was, nobody really knew at all what the values would be, because they couldn't see what chain consequences it could have, contagion consequences it could have. And it was immediately in the money market, there was contagion. So they basically the Fed had to come in and back up everything. It's a very chaotic time. I lived through it because I was actually involved with the New York Fed at the time. And there were days, the first day, there were days where we didn't know whether the whole world would collapse. And this is a concern, by the way, today. I think the same situation, it's more transparent in some ways through the stress test and so on, but these discontinuities are in some sense always there, because once the system starts collapsing, everything feeds on everything else, and it tends to be very chaotic. So I hope nothing will happen, but I worry that central banks have used up their sort of gunpowder to defend against this crisis in several steps already, so they don't have as much left. Certainly some countries won't have much left to protect their currencies and prevent crisis.
Can you explain this sort of, I know that you have explained this, what happened in the sovereign debt market in Europe. How was the information sensitivity removed from the market during the Euro crisis? It may be.
Yeah, so that's a fun case to see this sort of logic, information logic at work. The EU situation in the Euro crisis 2000 was it 2010 2012 or so, that spread from the US to Europe, that you saw that the spreads went up between the sovereign bonds, had differential spreads. Greece was the main object of concern at the time, and the spreads kept growing, and the response by the EU was to tell people that now we have 300 billion set aside to defend against this, which by the way is much more than the US had. They had only used 100 billion, but then they said, well, actually we have just increased it to 500 billion, and eventually people started calculating that if we take all our weapons in use, then we will have actually a whole trillion. Nothing of this really affected the spreads. This sort of explicit mention of how much more they had, it didn't do much good. And one reason being that when they collapsed, there's almost no amount of money enough to cover everything. So a trillion is a lot of money, but that's not enough to save all the European potential bankruptcies. Then eventually, they did stress tests also, and they did stress tests. They took the first half of what the US did, and they sort of explained what they studied the banks, and they came up with a ridiculous number, like, we need 2 billion to save this system. Or I don't remember what the number was, but I made it just very small. And so people asked, well, what do you mean? Did you test the Greece? And the answer was no, Greece we couldn't test because we don't know what is in the Greek banks. And everybody said, oh my God, that's the only thing we are worried about is really Greece. And so then they opened up their books and showed all the banks, including the Greek banks, sort of what they knew about it, and opened the book, so to speak. And of course that in this theory that I have propounded, that's the last thing you should be doing when you approach a crisis, opening the books, because then you are really opening the door to adverse selection. And so things got just much worse by that moment. And it was eventually Draghi that resolved this whole thing by saying, he only said that we will do whatever it takes and you better believe us. And the spreads came down. And this was a very opaque statement. The assumption in the minds of people was it took all the experts. Experts can't put the sentence, whatever it takes, into a spreadsheet and start calculating. So it brought it took away the experts' expertise to some extent. And also it assured people that probably they had been talking with Germany and there was on it. But it was the opaqueness of the statement that we are behind everything was ultimately what resolved that crisis. Unfortunately, Europe hasn't used the time to really fix their banking system. It's been 10 years since Draghi said that, and now we are again in sort of uncertain waters.
Thank you. Are there other questions? Yeah, Kunal, please.
President is Kunal Sen from UNU-WIDER. I wanted to focus on the second part of your presentation. I completely agree with you. You're absolutely right. The microfinance, the Grameen Bank, the BRAC experience has simply not been replicable in other parts of the developing world. And partly, as you said, because of scalable problems. And I totally agree also that this new approach to microfinance, the big data approach, might well be the way forward. But I wanted to ask you that what can one learn from the Chinese experience with WePay and Alipay and the Bangladesh experience with BCAS for other low-income countries? What can governments do to try and do what exactly happened in China and also happens in Bangladesh that you think is important from a policy point of view? Thanks.
Well, I think what you learn is that these work on the whole pretty well. I mean, they are not working perfectly, and that's why this JPAL, this institute that does these randomized control trials that have become so popular, they are trying to study exactly what the effects are from these systems. But they work well enough. Indonesia is going there. Indonesia has just started moving there. India is already having its own. I'm not that familiar with India, but India is having its own, version of BCAS, and I'm sure. So learning what they can learn from it is basically see, Alipay has shared with Bangladesh its information, with BCAS its information about they have invested there, and they have sort of described what they are doing. I'm not privy to knowing what other parties have shared information, but it's not like you can sort of, these are automated systems, these are computer systems. I mean, they are, as I said, very scalable also in the sense of transportable. Whereas we know that microfinance, for instance, of the old variety that Mohammed Yunus was using and was very valuable and still plays a valuable role, but it's just small scale because it takes it's very spotty. Some communities it works well, some communities it doesn't work well. You go to another nation, it doesn't work at all well. So you don't know how it works. Whereas it seems like these computerized systems, which are based not on interviewing people or anything like that. You just look at how people are behaving on this. And by the way, my colleagues Abhijit Banerji and Esther Duflo, who won the Nobel Prize in 2019 for this work on the JPAL and these randomized control trials, they are enthusiastic also about this and agree that it's sort of much more robust and much more transportable than and one of their point, I don't know if you have read the book Poor Economics, is that poor people are very astute. We Westerners and you know, people in rich countries think the poor people are just lying in the streets and they can't calculate anything. They are actually, if you go a little bit above that total misery, you see that the people who are really economists in this world or behaving like economically sophisticated people are the poor people. You see it, for instance, that they are paying, you know, for mobile phones. Even everybody has mobile phones in America, even the homeless here, and there's nobody anymore without a mobile phone because it's so valuable. And with that base, you know, as the tool of connecting is in your pocket all the time, that makes an enormous difference. And the Bangladesians, incidentally, learned to read. People didn't understand who are they going to call and how are they going to call when they can't even read and write. It turns out that it worked in the reverse when they got these phones originally in Bangladesh, which also was involved. This Kadir family was involved in that. That was an enormous impulse to learning to read. So there are other effects coming from this that have been very beneficial for in my understanding. I'm speaking to people who know a lot more about poverty than I do, so I'm a little hesitant, but I have followed this mobile phone arm, both as when I was on the Nokia board, and then later with the Loan Academy in China.
Thank you. All right. If there's no other questions, we thank Bengt Holmström very much for this very informative presentation and discussion, and thank you for all of those questions, and the session is closed. And I suppose dinner is at 7. So thank you very much.
Yeah.